The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
Okay. Well, welcome to the Fed. This is a great day. So I just want to get our day started. So good morning, everyone. My name is Art Lindo. I'm a Deputy Director in the Federal Reserve Board's Division of Supervision and Regulation, and I'm the head of our policy efforts in that group. I'm thrilled to be here today to help kick off the Federal Reserve Board's first conference on financial inclusion. Now, anyone who knows me knows that financial inclusion is a topic that is near and dear to my heart, given the fact that I am a first-generation American, and I believe that the U.S. financial system should be able to meet the needs of all Americans. So, efforts to address financial inclusion are broadly aligned with the Federal Reserve's missions of fostering optimal macroeconomic performance, improving financial stability, increasing payment systems efficiency, and enhancing financial institution integrity. In general, the financial capacity and capabilities of individuals, households, and small businesses are improved by broadening fair and affordable access to financial services. Such access can also create resilience among households and small businesses in the face of unexpected expenses, such as a sudden health event or an event that disrupts a local economy, both of which disproportionately impact those who are already underserved by the traditional financial system. While the Federal Reserve Board and the Federal Reserve System have been working on topics that have financial inclusion implications for many years, we humbly acknowledge that there is room for improvement. Today's conference is going to play an important role in helping us to move in the right direction. Throughout the day, we are going to hear from two of our oversight governors, along with a range of experts who are here to expand our understanding of financial inclusion and its impact on individuals, businesses, and the U.S. financial system. The fact that we are broadcasting today's sessions on our public website and YouTube highlights how important this topic is to the work we do here at the Federal Reserve Board. This conference shines a light on the importance of this topic and is a step towards a deeper understanding of factors that can improve inclusivity. So here's a quick rundown of the day. Our first session today brings together academics to shed light on the intersection of financial inclusion and bank safety and soundness. Areas that will be covered in this session include alternative data and credit underwriting, and the implications of bank practices on demand for alternative services such as payday loans, and innovations such as earned wage access products. I'm also looking forward to the second session this morning that will compare the implications of payments innovations for inclusion in the United States and in other jurisdictions. Our last session of the day will provide important perspectives on the consumer-related implications of financial inclusion, innovations inside and outside of the financial system. Now, before we start today's sessions, I would be remiss if I did not thank the people who helped to make this conference happen. Specifically, Uzma Wahab, Sonia Danberg, and David Newell, who have helped shepherd this work across the Federal Reserve System, and the board in particular. Even though we are one happy family at the Fed, as you know, there are squabbles between one another, and they make all those sort of things go away. So kudos for them for pulling this together with no fewer than 3 divisions of the Federal Reserve being represented here today. Now, I'd also like to acknowledge the work of the Federal Reserve Board's Financial Inclusion Working Group, who continue to push the board's collective understanding of the implications of financial inclusion on our daily work. And finally, the Conference Organizing Committee, which was led by Evan LaFleur and Kirsten Nolan, Drew Pack, Rhea Sonawayne, and PJ Tabbitt, who have been working tirelessly to make this conference happen. Thank you all. Now, it gives me great pleasure to introduce our first speaker of the day, Vice Chair for Supervision, Michael Barr. Michael Barr took office as the second Vice Chair for Supervision in July of 2022. Now, prior to joining the Board of Governors, Vice Chair Barr had a long and impactful career both in the public sector and in academia. While he's been a thought leader in many areas related to supervision and regulation of America's banking system, he has also distinguished himself with numerous works related to financial inclusion. This work includes his book, No Slack, The Financial Lives of Low-Income Americans, that was written in 2012, but has a number of insights and ideas that are still worth embracing over a decade later. Vice Chair Barr brings a lot of vision and energy to his approach to financial inclusion and other topics here at the Federal Reserve Board, which has made the past 2 years of working with him very interesting. With that, please join me in welcoming Vice Chair for Supervision, Michael Barr.
Thanks, Art. Let me just say how excited I am to be here as part of the Federal Reserve's inaugural conference on financial inclusion and innovation. Financial inclusion is central to the Federal Reserve's mission of promoting a strong and stable financial system and a healthy economy that works for everyone. This event brings together academics, practitioners, and thought leaders to discuss how financial products and practices are evolving to better meet the needs of individuals and businesses historically underserved by the financial system. I have spent much of my career in the public sector and academia working on topics related to financial inclusion. I found that projects that bring together public, private, academic, and nonprofit perspectives are often the most productive, since we all approach the issue differently and can learn from each other's perspectives. Forums like these provide good opportunities to form connections and spark collaboration. Looking over the past few decades, significant progress has been made in improving financial inclusion, including progress on many of the issues that will be discussed at this conference. And yet we still have further to go. Continued support for responsible innovation in this space is needed and can benefit from engagement across industry, academia, and regulators. This morning, I'll touch on how approaches to financial inclusion have evolved, where things stand today, and how we can continue to make progress towards a more inclusive financial system. The goal of financial inclusion is to improve access to affordable financial services that meet the needs of individuals and businesses. Banking the unbanked is part of that, but we also need to make sure that both bank and non-bank products and services are designed to meet the financial services needs of low and moderate income households. And we need strong consumer protection to guard against abuse. Banks are playing a pivotal role in innovating to serve low and moderate income households, sometimes in partnership with financial technology companies or fintechs. For example, we've seen a growing number of banks offering small dollar loans, expanding the use of alternative data to underwrite and price their credit products, and investing in tools to help better understand consumers' financial health. When adopted in a responsible and well-managed manner, with systems, processes, and policies in place to monitor and manage related risks, these innovations can broaden access to fair, affordable, and transparent credit. This in turn can create financial resilience among small businesses and help individuals and families become homeowners, build wealth, and become financially empowered. Innovations in banking services are important to improving financial inclusion. But to have durable impact on society, innovations must be adopted responsibly. Banks must have controls to manage risks and prevent violations of law, and their approach must keep pace with the growth of new products and services. Complexity can exacerbate risks and requires banks to pay particular attention to ensure that laws are followed and consumers protected. To the extent banks are working with fintech partners, banks have a responsibility to manage the risks associated with the third parties they partner with to serve their customers. We have unfortunately seen examples of failures of banks to effectively manage the risks of partnerships with other companies that support services to their end customers, and these failures have resulted in customer harm. In communities where people are living on tight budgets or with limited access to financial services, disruptions of this kind can be catastrophic. These examples are a reminder that providing innovative financial services comes with responsibilities to ensure that risks are appropriately controlled. Durably supporting financial inclusion means ensuring that necessary controls grow in step. We do see great promise to improve financial access when innovation is done with appropriate risk controls in place. One such promising avenue is the use of alternative data in credit decisions involving small dollar loans. Historically, access to the financial system was limited for many households and small businesses that lacked key financial credentials. For example, traditional credit models favor an applicant that already has a sufficient credit history and a file from a credit reporting bureau to qualify for lending. This leads to a catch-22, where lower income applicants with scant credit history but ample ability to repay are denied access to credit because they don't have a credit history. As a result, many lower-income households, both banked and unbanked, end up using a range of formal and informal services outside the banking system that too often keep households in a cycle of debt. Actions by the Federal Reserve have supported the opportunities as well as identified potential risks associated with innovations in bank products and practices marketed to those who otherwise have limited access to the financial system. In 2019, the Federal Reserve's alternative data statement highlighted the benefits and risks when banks and non-bank firms leverage alternative data in credit underwriting, particularly for borrowers that have been locked out of conventional borrowing. This guidance underscored the potential benefit of using data that has a clear connection to creditworthiness, such as information on inflows and outflows from a bank customer's deposit account. With a share of households with bank accounts much larger than the share with credit scores, and especially with prime or near-prime credit scores, this information has the potential to allow underwriting of a much larger pool of potential reliable borrowers. In addition, in 2020, the Federal Reserve issued principles for responsible small dollar lending, typically uncollateralized loans of less than $2,000 that often leverage alternative data while being underwritten. This guidance has encouraged the spread of these types of loans to households and small businesses that otherwise would have had limited access to credit. In addition, given the small but growing number of banks partnering with fintechs for alternative data and small dollar lending, among other things, the Federal Reserve issued guidance in 2023 and in 2024 on how to responsibly manage these third-party relationships. Taken together, these statements are helpful resources to ensure that banks are using the technological innovations from third parties in safe and responsible ways. As noted in the alternative data guidance, alternative data can be sourced from a bank's own relationship with its customers. And evidence from research and industry experimentation suggests that information on cash flow from an individual's bank account can help predict credit risk and expand credit access. We are already seeing progress in this space. Banks and credit unions of all sizes are starting to use alternative data to offer small dollar loans to their existing customers with short-term liquidity needs. Given the early promise of these loans, this area seems particularly suitable for banks to innovate and experiment safely and fairly within the confines of safety and soundness standards and consumer protection laws. In addition, banks and others have done extensive work over the past few years to measure the impact of bank products on the financial outcomes of customers. Among these metrics are a set of financial health indicators around a customer's cash flow and payment history that capture their ability to meet their own short-term liquidity needs, build financial capacity, and affordably access financial services over time. Such indicators can help banks better understand the impact of their products and services on their customers so that they support their customers' longer-term financial resilience. These indicators can also equip customers with the transparency and tools to assess financial services offerings. I'd also like to highlight the potential for real-time payment systems, including FedNow and private sector systems, to advance financial inclusion. These services will enable banks to offer customers the ability to send and receive money immediately, which can help customers weather income disruption and unexpected expenses. By reducing payment delays and the high costs for consumers associated with those delays, FedNow can over time improve access to the financial system and lower costs. I'm also interested to see how increased access to consumer-authorized data will change the landscape for innovation. As the rules, regulations, and practices related to expanded access and sharing of customer permission data flows evolve, consumers may benefit from having a fuller picture of their financial life to better understand ways to improve their financial health. Customer permission data access, alongside innovations in digital identity, also has the potential to allow banks to better assess a borrower's creditworthiness, increase customer access to financial services, offer customized and innovative financial products, and empower individuals to move more freely in the emerging digital financial landscape. Of course, bank adoption will play a key role in unlocking the power of such innovations. As with most innovations, regulators will need to ensure appropriate measures are in place to protect consumers and promote financial stability. For example, regulators will need to be diligent so that the entities to which consumers grant access to their data safeguard privacy and data security. Let me now turn to the importance of the Community Reinvestment Act, or CRA, in its role in advancing financial inclusion. As we all know, access to financial services and credit is fundamental to economic security and vital to strong communities. This access is the foundation of home ownership, education, small business development, and other economic activities that improve our lives and our neighborhoods. I want to relate these values to the CRA and the Federal Reserve's commitment to encourage access to credit in low and moderate income communities. Congress enacted the CRA in 1977 as one of a set of laws, together with the Home Mortgage Disclosure Act, the Fair Housing Act, and the Equal Credit Opportunity Act, to address redlining, other forms of racial discrimination, and lack of access to credit in low and moderate income communities. Fair lending laws set the unequivocal standard that there is no place for such discrimination in the financial system. Federal banking agencies reinforce this standard by taking a bank's fair lending record into account when assigning a CRA rating and evaluating whether banks meet the credit needs in low and moderate income communities, consistent with safe and sound lending. Through the enactment of the CRA, Congress charged the Federal Reserve and other federal bank regulators with the responsibility of assessing the performance of banks in meeting the credit needs of low and moderate income communities. Throughout the CRA's nearly 50 years of supervisory history, the agencies have strived to provide guidance that reflect the dynamic changes in the financial landscape, and at some point in time, revise the regulations to do so. Last October, the federal banking regulatory agencies issued a final rule to strengthen and modernize the regulations implementing the CRA. Prior to the issuance of the final rule, the regulations had not been significantly updated since 1995. Throughout the rulemaking process, bankers and community groups consistently emphasized the need for greater clarity, consistency, and transparency than was provided under the existing rules and guidance. In response, much of the detail in the final rule is designed to provide that additional clarity. The final rule standardizes the evaluation approach so that it is more consistent across the agencies and more transparent to banks and the public. It does this in a way that builds on how CRA examinations are conducted today. The final rule includes several provisions intended to advance financial inclusion. For example, it emphasizes the work that minority depository institutions and community development financial institutions do to expand access to credit and opportunity in underserved communities. It also provides a focus on activities that serve native land areas, persistent poverty areas, and other high-need areas. We take our supervisory responsibilities under the CRA seriously, knowing that it helps to foster real opportunity for consumers and communities. The CRA has served as a critical tool to support financial inclusion across the country since its passage, and will remain a vital tool for bankers and community organizations to work together to promote financial inclusion and economic development in low and moderate income communities. Given the importance of innovation to the goal of financial inclusion, I'm grateful that we've been able to gather so many experts on the topic related to it. While we've made considerable progress, we need to continue our efforts to support greater inclusion in a financial system that meets the needs of all Americans. At the Federal Reserve, we will continue to work to improve our understanding of the innovations in financial inclusion and the intersection of payments innovation and financial inclusion, among others. We'll also use our position to monitor innovations that have financial inclusion implications, such as alternative data use and financial health measurement, and keep the public informed on the evolving industry practices that help meet the needs of the financially underserved. For example, we expect to provide additional resources on alternative data use in the coming months. In addition, the Fed's Partnership for Progress programs helps minority depository institutions and women depository institutions navigate the unique business challenges, provides MDIs and WDIs with resources for technical assistance, and conducts research on the unique challenges faced by low and moderate income communities. We also actively partner with Native American communities to better understand their financial services needs. In addition to the Federal Reserve's role, the private sector is a key source for financial innovation, and we encourage businesses to responsibly innovate so that new tools can increase financial inclusiveness that are safe for customers and consistent with financial stability. We would all benefit from additional research in this area. For instance, how do we help ensure that expanding access to fair and affordable credit advances safe and sound lending? Empirically, which innovations are best able to meet customer needs safely and affordably, maintain bank safety and soundness, and promote a healthier economy? And how can we leverage concepts in behavioral economics to improve the effectiveness of credit products? I hope the conversations in today's conference can spark productive dialogue and spur potential research in these areas. In closing, my hope is that these kinds of efforts, as well as continued innovation in the banking system, can bring us closer to a time when all families and communities in our country have adequate access to credit and financial services on fair, affordable, transparent, and accessible terms. Thank you very much. Thank you. Yeah, I'd be happy to take a couple questions if you have them.
Okay, Vice Chair, we'll take a couple questions. We have a mic floating out there. If you have a question for the Vice Chair you'd like to raise, we'll recognize you. This is financial inclusion. You participate, right? Anyone? Okay, we got hands here in the front and over there. We'll take two questions.
Good morning, Governor Barr. Thank you for your remarks. I appreciated the mention of financial health measurement as an important opportunity, both for banks to understand their own customers and for customers to understand their own situation. I'm curious if you could imagine a day in which financial health measurement actually becomes part of the way in which banks are supervised.
That's a great question. I don't know the answer to it. It's possible. So the question is, can financial health metrics be an important part of how we think about supervising institutions? Right now, we have two kinds of approaches that we use for supervision of banks. We supervise for essentially the inputs into financial health. That is, are they following the rules and regulations under consumer protection? And we also supervise separately for safety and soundness, for the health of the banking system. Our safety and soundness approach is kind of a principle-based approach. We're looking not only at compliance with the law, but also at how an institution actually manages its relationships and its capital and its liquidity and its other adequacies. So we can have an institution that complies with the law in a narrow sense, but doesn't comply with the law in a broader sense. That is, it's not meeting the principle of safety and soundness, and we do cite violations of that under our existing authority. So in the consumer protection space, if we were using financial health as a metric, we would need to, under existing law, embed that in the system of rules and regulations that we comply for. But it's really an interesting thought, because the purpose of all those laws is so that consumers have good outcomes in the world, or at least that they're protected from the very worst outcomes. So it's a great question.
Vice Chair Barr, if you had to prioritize, how would you tell banks that, or what's the best way to tell an institution that, yes, you have to worry about safety and soundness and you have to worry about consumer protection, but how do we move them to say, but you can be innovative? The CFPB had no action letters, for example, for a while to give people a safe harbor. We don't do that anymore. They don't do that anymore. We don't do that. What would you do to push institutions to say, hey, it's not so bad?
Well, let me start with the basic, proposition. Fair lending is safe and sound lending. Those two things are not in conflict with each other. They're mutually reinforcing for each other. If you're engaging in fair lending, you're engaging in safe and sound lending. So at a very high level, I would start with the proposition that if you're serving your communities well, you are of necessity engaging in behavior that is consistent with what we want you to do, both from a consumer protection perspective and from a safety and soundness perspective. If you're serving your consumers well, if you're meeting the needs of low and moderate income communities in a responsible way, you are engaged in safe and sound lending. So that's where I would start. It's been great talking with you all. Thanks for having me here. Enjoy the rest of your conference, and look forward to hearing the results.
Okay, thank you, Vice Chair Barr. Now we'll move forward with our first panel of the day. I'll ask my panelists to join me. So Nikita and Damutu. Okay, why don't you come up? Before you start, I'll do a little introduction. Okay, so as I mentioned, our first session today brings together three academics who have conducted extensive research to help further our understanding of the intersection of financially inclusive products and practices with consumer outcomes, as well as with safety and soundness of our financial institutions in mind. As Vice Chair Barr just conveyed in his remarks, this intersection is one where more research will not only help us as supervisors and policymakers, but also help the public better understand the implications of such innovations to help shape products and services and inform consumer choice. Before we start the discussion, let me spend a few minutes introducing our panelists. So to my right, there is Damutu Ratnati Waka'a. Dr. Ratha Ratnati Wak-R-R, is an assistant professor of finance at the E.J. Orso College of Business at Louisiana State University. He has written extensively on topics related to household finance, banking, fintech innovations, and real estate finance. And we just learned that in a few months, he will be joining us here at the Federal Reserve at our Richmond Reserve Bank. So welcome. To my left, I have Nikita Coutinho. Ms. Nikita Coutinho, is an associate professor of law at Georgetown University School of Law. Her scholarship examines the interplay between financial inclusion, private ordering, and regulation to address economic inequality. She also teaches seminars around the intersection of fintech innovation and financial democratization. Prior to joining Georgetown Law, Professor Coutinho was a visiting assistant professor at Duke University's School of Law. Previously, she practiced as a corporate associate with Simpson, Thacher, and Bartlett. And on the screen today, we have Dr. Emily Williams, who is an assistant professor of business administration at Harvard's Business School. Professor Williams' research focuses on financial intermediation, traditional intermediation and payments, the use of technology in financial intermediation, and the financial services offered to the underbanked. This session will be structured whereby each of the panelists will spend a few minutes discussing their work, which will be followed up by a moderated discussion. We will then end with Q&A from those here in the room. In terms of ordering, we will first go with Dr. Ratnati Wak-R-R, to my right, who's going to walk through his academic work and about the implications of lending underwritten by alternative data on so-called invisible primes. Following his presentation, Professor Coutinho will briefly discuss her work on the implications of financial innovations, such as earned wage access products on banks, customers, and on the financial regulatory landscape. And then finally, Dr. Williams will then wrap up this part of the session by presenting her research around financial inclusion, implications of changes in certain practices. With that, I'm going to turn it over to Dr. Ratnati Wak-R-R.
All right. Thank you very much for inviting me. It's a pleasure to be here. So during my presentation, I'm going to talk about some of the results from one of my research papers with Marco DiMaggio. So this paper, what we're trying to do is to see whether the alternative data, in addition to traditional measures of creditworthiness, can help us in expanding access to credit. And also, what kind of impact would that have on individuals who get access to credit? So if you look at people, the Americans who had access to some type of credit product, 80% of these people have never defaulted on any of these credit products. But if you look at the types of credit they had access to, only about half of them had access to bank quality credit. So there is this big mismatch, and this mismatch highlights there are problems in our credit system. One of the main reasons for this is the way in which the traditional lenders evaluate the creditworthiness of potential borrowers. They rely on a handful of traditional variables, mostly the credit score. The credit score works well on average. As you can see here, there are these two plots that shows that there is this strong negative correlation between the credit score and the default behavior, both in credit card defaults as well as mortgage defaults. However, there are some limitations to these traditional measures. So if you look at this plot, this shows the distribution of the credit scores of the US adult population. So whenever we want to apply for some type of a loan, particularly unsecured loans, there are often credit score thresholds. If you fall below those thresholds, you are immediately disqualified. Typically, for unsecured lending, this threshold is around 660, right? So what you see from here is that there is a large fraction of the population who has credit scores would fall below what is typically used threshold of 660. But what we're trying to argue here in this paper is that in that segment, you could have people like recent graduates, recent immigrants, self-employed people, or people who have never borrowed in the past, who are actually credit-worthy, but for them, this credit score is not very informative, so therefore they are shut out from the formal credit markets. So that is if you have a credit score. There are about 20 million Americans who don't have a credit score at all, so they cannot participate in this formal credit market. So we are talking about a large fraction of the American adult population who cannot participate in the formal credit market. So what we are trying to do in this paper is to see if we can use alternative data and also sophisticated underwriting models to identify that segment of the population who fall below these thresholds but are actually credit-worthy. We call them invisible primes because they're invisible to traditional lenders but are actually credit-worthy. So can we identify them using alternative data and sophisticated underwriting models? And then, are they sufficiently credit-worthy to give them affordable credit? Can we give them loans at reasonable interest rates? So that's the second thing we are looking at in this paper. And finally, we are going to look at what kind of impact would this have on these invisible primes when you give them access to affordable credit, whether that benefits them financially or not. That's an empirical question that we are trying to answer. All right, so to answer these questions, we got access to this data from this fintech, Upstart. Upstart, the fintech, is a publicly listed company on NASDAQ. And this is a very good setting for us because Upstart is known for its use of AI and alternative data in their underwriting algorithms. And the CFPB, as was mentioned earlier, issued a no-action letter after evaluating Upstart's underwriting model. So this is something that is working within the regulatory framework, acceptable to the regulators. So we have a model that is sort of working within the regulatory boundaries, and we have data on applications and outcomes from this company, so we can try and answer some of these questions that Vice Chair talked about earlier. All right, so in addition to the data at the time of application, a key feature of our data is that we are able to track all these applicants who are coming to this platform, not just at the time of application, but after a period of 1 year, so we can get access to their credit report, so we can understand what happened to them 1 year after either being rejected or approved for credit. So in the rest of the presentation, I'm going to refer to the platform's underwriting model, so which is the model that this fintech developed, which uses alternative data and artificial intelligence. And we have 3 benchmarks that we compare this model against. One is a traditional model that CFPB developed in coordination with the Upstart to represent what a traditional lender would use. And in addition, we have an actual underwriting model from a large bank. We are going to use that as our second benchmark. And the third benchmark is just the credit score, because this is one of the key variables that go into most of the lenders' underwriting models. So I'm going to start by showing you the pool of applicants that are coming to this platform. Right, so what we are doing here is that we are grouping these applicants into different bins based on their credit scores. So that is what you see on the x-axis. So to the left, you see the applicants with credit scores between 600 and 620. And on the y-axis, what you're seeing here is the estimate of the probability of default from that platform's sophisticated underwriting model. Right? So what this says or shows you is that even though the traditional measure says that these individuals are not creditworthy, they have low credit scores, the platform's model is giving them a very low probability of default. So that model is telling us that maybe they're actually creditworthy, even though the traditional measures are telling us they're not creditworthy. Right? So this is ex ante, before the loan is originated. Now we look at the actual default rates after the loan was originated. Again, the x-axis is the credit score bins, y-axis is the probability of default bins, like in the previous plot. And here you see the color represents the actual default rates in these different groups. Light blue means low defaults, dark blue means high defaults. So you see that these individuals are indeed invisible primes because their actual default rates are also lower, very similar to the default rates of somebody with a credit score of 740, 750. Right? So this model is doing a pretty good job in identifying these so-called invisible primes. So next, we dig into what is driving this superior performance. We know that this model is using alternative data as well as AI. What is driving this superior performance? Is it the data or is it the more sophisticated model? Right? What we found is that most of this superior performance is coming from alternative data that this platform is using. It's the most important variables for this would be the applicant's education, what type of a job the applicant has, whether it's an hourly paid job or a salaried job, or what type of a device these applicants use to fill out the application. This seems to be most important in identifying these invisible primes. And finally, I'm going to talk about, so now, now we know that the platform's model is able to identify these invisible primes. What kind of impact does this have in terms of credit access? So here what we are looking at is all the applicants that were approved by this platform's underwriting model. And then for each credit score bin, we are looking at what fraction of them would have been denied credit under those other benchmarks that I talked about. Right? So what you see here is that when you have low credit scores, about 20 to 30% of them would have been denied access to credit by traditional underwriting model. And so therefore, this is sort of you can sort of broadly think this as the size of that invisible prime segment in the left-hand side of the credit score distribution. In terms of the intensive margin, the interest rate, we do a similar exercise where we are comparing what is the interest rate that they would have received under that benchmark 1 to what is the interest rate that they're actually receiving. So we see, if you look at the individuals with credit scores of 620, borrowing $10,000 for a period of 5 years, they're able to save like $8,000 in nominal terms because of this more sophisticated underwriting model. Of course, the benefit goes down as the credit score goes up. And finally, we try to answer this question, okay, what kind of an impact does this more credit have on these invisible primes? This is not an easy question to answer because we don't know the counterfactual. If they don't get access to credit, what would have happened? So to address this, what we do is we leverage some of the hard disqualifying criteria that this platform has. For example, the platform has a sharp disqualification criteria around debt-to-income ratio of 50%. If you are above that 50%, you are immediately disqualified. If you are below that 50%, you can be approved for credit. So we compare the individuals just above and just below these cutoffs. So we are going to argue that they're very similar, except this, some people have debt-to-income ratios of 49, some people have 51. That's the only difference. And then we leverage this discontinuity and run some regressions. What we find is that if you have low credit scores, and if you can get access to credit from this platform's underwriting algorithm, we see that their financial health improves after 1 year. Their credit score goes up. They're less likely to default on their credit card debt and other debt. And also, this last result is not that strong. They're more likely to purchase their first home. So it's sort of a sign of them being transitioning from being invisible to being visible to the traditional lenders as well. So to conclude, what we find in this paper is that credit scores are not reliable for certain segments of the population. And we can use alternative data and artificial intelligence to identify these invisible primes, and when they get access to credit, it seems that if you have low credit scores or if you are underserved, then that has a positive impact on your financial health. Thank you very much.
Ms. Coutinho, you can either go to the podium or right there. Whatever you prefer. You're fine. Go ahead.
Okay. Is this on? Oh, thank you. Good morning, everyone. Thank you for having me. I'm really excited to be a part of this discussion. And it's awesome to have someone present first, because part of what I was going to say was just covered. So now I get to present like a shorter, more abbreviated version. So thank you. But the first part I want to talk about is obviously a huge friction point for financial inclusion is credit access. And so credit can be a gift or a curse, and that's debatable. But what's not really debatable is the fact that it's a necessity for most people. Whether we're purchasing homes, cars, or food, most Americans depend on credit, not just to build wealth or for luxuries, but for basic daily needs. And so I'd be remiss to say that there's a worthwhile discussion to have about our credit dependence, and it's not within the scope of this particular program, but more ambitious cures to that might be higher wages or expanding the social safety net. But the discussion about sort of what the role of financial regulation, banks, and markets play is not mutually exclusive. Those things can and should happen together. So in thinking about the role of financial regulation, policy, and banks, one question I often ask, or usually ask myself, is how can we make safe credit broadly accessible to all those who need it in light of our current economic reality? And so my research identifies, or at least tries to categorize some of the innovations into two broad approaches. One is to evade the credit markets or to expand the credit markets. And I'll touch briefly on some promises and pitfalls of taking either approach with some of the innovations. And the first is earned wage access programs. And so in this project, I had looked at earned wage access programs, which aim to evade the traditional credit market system by offering liquidity or cash advances, or any term other than loans, but offering funds in advance of a user's payday based on the fact that they have earned the income but have yet to be paid that income. And so these programs are repaid automatically based on the user's next payday, and often subject to either subscription fee or transaction fee. Some purport to be free and recommend or nudge tips. And so these services are said to be sort of low-cost or no-cost alternatives to high-cost, often deemed risky loan services like payday loans. And also they're often sort of marketed as not being loan products at all. They're payment services, or ATM for your paycheck, as one early provider said. But my article found that, or argues at least, that notwithstanding some positive characteristics of the earned wage access sort of marketplace, the high payday loan-like risk of the market warrant regulatory scrutiny. So to start with some positives, like to be sure, earned wage access market has at least three characteristics that are worth like sort of grappling with and trying to figure out the proper solution. And the first is that having a poor or no credit score isn't a barrier to this sort of liquidity. It's based on provable earnings and limited to the amount that you've earned, so they sort of limit their credit default risk. And that way, and also having it automatically paid, it limits default risk. And so to the extent we want to promote liquidity, notwithstanding someone's credit invisibility or having a poor score, earned wage access programs sort of aim to solve for that to some extent. Second, non-habitual use of earned wage access programs can fill a market void for like an intermediate level or a pricing level for short-term, small dollar liquidity. Some of the programs are $2 to $3 per transaction. Subscriptions are less than $10 monthly. And of course, the tip-based service, which is the most popular and often most hotly debated one, it's free, but now it's capped its tips at like $13 per transaction. So a one-off usage of this can be cheaper than a payday loan in some of the high-cost fringe services. And so to the extent that the user is just experiencing a timing delay or a timing friction with their income versus their payments, this could be an okay service. And then finally, what I think is the most promising feature of them, a certain earned wage access programs, is when they're subsidized or covered by the employer. And that's because this takes the burden of the periodic pay period that's arguably caused by the employer, who, instead of paying workers daily, they are now paying them biweekly or monthly. And so there's a solid argument that the worker is providing a low-cost or interest-free loan to their employer as they hold their funds until payday. But the worker bears the cost of that sort of loan to the employer to the extent they need their funds instantly. And so if it's subsidized or covered by an employer, that is now the employer bearing the cost of holding the workers' funds. And then also the employer is better positioned to negotiate better financial terms for sort of a broad, low-wage worker base as opposed to these workers individually trying to negotiate or source low-cost credit terms on their own. And so the sort of power and the size of an employer could be useful in navigating or negotiating good financial services for workers. Okay, so the bad stuff, or at least the questionable stuff. And so I identify at least 4 risks when it comes to earned wage access programs that I say that really can't be overlooked despite their promise. And first is despite calling it an ATM withdrawal on your earnings or just a payment service, what's effectively happening is people are calculating sort of today's usage of tomorrow's funds. It's the same calculation one makes when they're borrowing. And so it raises the same behavioral risk concerns and sort of intertemporal decision-making. And can you borrow from your future self? Do you actually have the ability to pay for now and then? And so those calculations are the same. And since those are similar calculations, the risks are similar, and that if you are drawing down on funds that you have to automatically pay in the future, and you actually don't have the bandwidth to do that, well, now you're facing other fees once that automatic payment comes out. And not only in facing other fees when that automatic payment comes out, you're compelled to reuse the product, again, similarly to a payday loan. And so it's the habitual use that turns these one-off, seemingly innocent fees into a snowball of costs that have APRs in the similar range of 200 to 500% APR that, again, can rival payday loan fees. And so if users are not just having one-off sort of timing constraints, but actually have sort of permanent liquidity shortfalls or their income is insufficient, well, then they're facing the same sort of high-cost fringe credit concerns that we see with payday lending generally. And then like with payday lending, earned wage access programs aren't reported to credit bureaus. And so again, to the extent you're credit invisible, this isn't a service that's going to help you build a score or help you bridge yourself towards a mainstream credit products. And then finally, the 4th risk is that, despite all of these concerns and risks that are loan-like, many of these products aren't regulated like loans. I've been trying to track sort of the state action. It's a lot of varying approaches happening, and the industry is lobbying for a particular regulatory approach that is to carve out earned wage access programs from lending laws and regulations. Some states, a handful of states, including Kansas, Missouri, and Nevada, have explicitly carved out earned wage access programs from lending regulations and created an independent regulatory framework from them, while other states, like Connecticut, says that they're squarely within their lending regulations, and that even tip-based services, to the extent there's a tip, that's a finance charge that should be sort of reported and interrogated as such. And other states are in sort of varying process of bills dying or trying to figure out where they situate these products. And so for me, given the very real needs that these products are trying to address, but they're very real risk, the question is, what should regulators, banks, or even earned wage access programs do in order to sort of solve the problem without exacerbating the harms? And for me, a few things come to mind. The first is bank partnerships with employers for sort of free, instant, direct pay. Taking from earned wage access programs the concept that workers should have a right to their pay daily or more frequently than they currently do, is there a way for the system to facilitate that without actually taxing the worker for accessing that income? And on the flip side, is there a harm in doing that? Even though it may be free, there might be some other concern with allowing, or not so much allowing, but there might be some other cost to having workers access their funds more regularly. They may spend more. And so assessing sort of the trade-off and having daily pay or daily income as opposed to biweekly or monthly income, what does that look like and what can be done about that? So researching the sort of the cash flow implications of that. And then always, is there a low-cost, maybe income-based credit solution that does not consider the credit score in a similar fashion, but is tied to income, but does build credit and allows you to then sort of bridge the gap or mature into the mainstream market. And so that's not only the evading the market, and then expanding the credit market relates to the earlier presentation, and that's like with alternative data. They're trying to expand access to the mainstream market. And so there are the promises that were mentioned earlier, and I have a working paper that's, again, it's like trying to weigh the balance. So there are these promises, but we can't ignore the cost of these things. And so the cost of alternative data gives, especially also me being academic, I have free range to figure out a really ambitious solution for these things, right? And so I'm like, to me, the cost of alternative data are at least fourfold. The first, there's privacy concerns or privacy risk, especially as you have the various credit bureaus using alternative data to enhance their models. In the event of a data breach, now you have more access to cash flows and education, a whole bunch more information that is now vulnerable for individuals. Are we okay with that, or what do we do to beef up that risk? Then there's an over-surveillance concern, insofar as unscored consumers are already from vulnerable populations that are already subject to heightened surveillance, whether it's purchasing food, whether it's housing, or just navigating their neighborhoods. Now they have to expose themselves to another heightened degree of surveillance just to access credit because you're using alternative data metrics in order to assess their creditworthiness in a way that's unique from people who have access to credit or have more privileged access points, whether they've gone to college and had a student card, or whether they have a parent who's put them on their account, or whether they have funds to pay for a secured account. Those individuals won't have to subject themselves to the same level of alternative information if they don't want to, but certain people will always have to. So again, there's this over-surveillance concern there. And then related to that, there's the potential for harmful nudging. Now you have more information about a particularly already vulnerable group who's giving you more information in order to access credit. Can that be used to nudge them into certainly good products, but also some risky products? How do we manage the use of that heightened data? And then, of course, there's the discriminatory impact that many scholars have noted with alternative data. And actually the point about Upstart is that there was at least a consumer protection watchdog group who did some applications to assess, how equitable Upstart's education assessment benefits were. And as a graduate of Howard University, I probably wouldn't have fared well with Upstart's program because it was having a disparate impact on HBCU graduates despite having comparable sort of income, employment, and other sort of data or metrics. And so while there were benefits to it, there were risks with entrenching some racial inequities that actually might not relate to a person's sort of financial creditworthiness. And then the last point on that, sort of related to that, is in taking in some alternative data points, there are some programs and even some services that might consider, for example, rental histories. And that can certainly be helpful for individuals who rent. But there's a disproportionate number of minorities who actually stay home longer, statistically, whether culturally or because of cost, and it actually makes financial sense to stay home. But now you're invisible in another way because you're not paying rent and building a profile in that way. And so there are alternative data can be helpful, but there's these concerns or risks or shortcomings to think about when including it or trying to incorporate it. And so I say, why not just presume creditworthiness at the outset? If alternative data is demonstrating that a good number, if not the vast majority of credit invisibles are actually creditworthy, why don't we just deem them creditworthy for their first entry into the marketplace? And the data also suggests that it's much less the sort of character of the individual, where creditworthiness comes from, that dictates their performance with the loan, but actually the loan terms. So if you give them fair terms to start, then they will reveal their creditworthiness to you over the long run. And so presuming them creditworthy at the outset might actually be the best, most equitable way, because there's no particular group who has to share more information, and each person has an equitable start into the marketplace, and then it will be a true assessment of their creditworthiness because everyone has fair terms. So how do you create that? How does that actually sort of play out in practice? Well, it could be by encouraging banks to create sort of a low-cost, income-based, not credit-based sort of credit products. We also have the special purpose credit programs that are sort of might be in limbo in this current moment on whether or not they would be sort of legal going forward in light of affirmative action cases, but you can create credit programs that are entry products intended to give individuals fair terms and a fair start. And so I'll stop there. Sorry if I've gone over, but thank you.
Okay, we have one more academic. Dr. Williams, we'll turn to you next. We may need to advance her slides. You have the floor.
Wonderful. Thank you so much. I'm absolutely thrilled to be here and, sad not to be there in person, but very grateful for the technology that allows me to be here virtually. So I'm going to start by introducing myself and my work, and then sort of bringing us back to the definition of what we really think financial inclusion is and how regulation sort of interacts with that. And then I'm going to be much more specific about one particular piece of my work, which links together sort of the traditional and alternative financial system to try to really round out these, these discussions of things that we might want to think about when we think about financial inclusion. Next slide. Next slide, please. Yeah, perfect. The one before, so that the text, perfect. One before, thank you so much. Right, so broadly, I do empirical work, trying to understand the state of financial inclusion in the United States and how we can improve it. And at the outset, that's not really an obvious, idea, or there's no obvious sort of real problem there. And when you think about the United States, it has a very highly developed financial system. And so the question is, why are there so many households without access to what we think are basic financial services? And as you know, the panelists before me have sort of mentioned these numbers. For example, the FDIC from 2021 notes that around 6 million US households are unbanked, meaning that no one in the household has access to a bank account, or 18.7 million households are underbanked, meaning that maybe someone within the household has access to a bank account, but they also use frequently other alternative financial services, such as say payday lenders or check cashers, things like that. And then sort of moving on from unbanked and underbanked, when we think about, these, credit or being credit served or not, according to TransUnion in 2022, 45 million Americans are either credit unserved or credit underserved. And these numbers are astounding. In a highly developed financial system such as that within the United States, how can this possibly be the case nowadays? So my work aims to try to understand this. I have work on buy now, pay later, real-time payments, things like social networks and household finance, or the informal financial system that might be operating in the United States, and other things like climate change and household finance, and also the rising cost of housing and how that impacts inequality and business cycles. But Today's focus, as I mentioned before, I'm going to discuss linkages between some traditional and alternative financial systems that could be important. And I really want the takeaway of sort of my discussion to be that when we think about financial inclusion, we must leave absolutely no stone unturned and make no sort of assumptions when we're trying to understand how the provision of financial products impact the lives of some of the most vulnerable, financially vulnerable people in the United States. Thank you. Next slide. You have to click one more time just to get the perfect. So what do we mean by financial inclusion? And there's many different ways to think about this, but one way to sort of put it is easy access to useful, affordable, transparent financial products and services that are easy to use and that, very importantly, actually meet the needs of individuals and businesses. Next slide. And so when we think about what sort of institutions we want to provide these products, we want the private sector to provide products that kind of meet these criteria for financially inclusive products. However, there's an inherent misalignment, of course, between the private sector and consumer incentives and also power between these sort of two entities. And that means that there's space for regulation. And the right regulation is absolutely vital, particularly in the case of thinking about financially inclusive products, because low-income individuals are particularly vulnerable to things like hidden fees and predatory behavior. And that's because these consumers often have less access to, say, financial education, just less experience generally interacting with the financial system, but really importantly, fewer resources to absorb any unexpected costs that might come from sort of predatory behavior or unexpected or sort of elusive fees. Next slide. So when we think about sort of what types of institutions might engage in predatory behavior, I think that there's a common belief that the types of financial institutions that might engage in this type of behavior are going to be sort of non-banks and alternative finance providers. And, for example, like payday lenders or, institutions like that, they get a bad rap a lot of the time. And it's probably true on average that these institutions, maybe do engage in more predatory practices on average, probably because of the fact that, by definition, these institutions are less regulated. However, despite being heavily regulated, banks still find ways to maximize profits, likely at the expense of low-income consumers via, let's say, arguably predatory behaviors. And of course, I want to use my language carefully here because, we have to be, it's very difficult to sort of conclusively pinpoint a predatory behavior. But what I want to do is give you one example of arguably predatory behavior by banks, which is high to low reordering of transactions that is thought to maximize revenue earned from overdraft fees. Next slide. Thank you. So to give you an example and to just fix ideas, high to low reordering at banks works like this. So suppose we start with a checking account balance of, let's say, $400 at the start of the day. And then chronologically, your bills come out as follows. You have a $50 electric bill, then you spend $50 on groceries, and then your $500 rent payment comes out from your bank account. Suppose that those transactions are considered in chronological order. Then, of course, you see that it's the $500 rent payment at the very end that's going to trigger an overdraft fee. And so you incur one overdraft fee. However, when banks engage in high to low reordering, what they do is they resort, at the end of the day, they resort the transactions from the highest in amount to the lowest. And so the $500 rent payment comes out first and triggers one overdraft fee. And then the following two transactions also come out and also trigger overdraft fees. And so with high to low reordering, with this example, you can see that when you order the transactions from high to low, that the consumer is more likely to incur multiple overdraft fees at once. And when you sort of sign your deposit account agreement, which is, something that I don't think anybody really reads, it's this like very large document in sort of size 10 font, you can see when you read it in detail that you have agreed that the bank is allowed to reorder your transactions however they wish. However, it's incredibly difficult to understand the implications of what that means for you, especially as a low-income consumer. Next slide. So in this paper in the red, overdrafts, payday lending, and underbanked, with my colleagues Marco Di Maggio and Angela Ma, we wanted to study what was the impact of high to low reordering on lower income consumers. And the idea is we sort of our initial hypothesis was that there's a link between excessive bank fees and demand for high cost alternative financial services such as payday loans. And why is that? Well, once you get hit with these excessive fees, which can really pile up, you would rather pay for an expensive payday loan to manage these excessive fees than default within the banking system, because there's absolutely massive consequences of doing that. For example, you get blacklisted. It's very difficult to open another bank account somewhere else, which again has sort of very negative knock-on consequences. And it can also impact your credit score and things like that. And so we wanted to understand, sort of, is this hypothesis, does it hold out? And sort of what are the implications of these types of practices that, sort of these arguably predatory, excessive fee-taking behaviors for lower income consumers. Next slide. Thank you. So what we find, so we start off by looking just at correlations, and we use this really interesting data compiled by the Pew Institute. So basically we have data from the largest 50 banks. And so we're only comparing large banks to large banks. And Pew established over a number of years whether or not these banks engaged in high to low reordering. And again, it's very, very difficult to observe this behavior, incredibly difficult, actually impossible without, doing things like surveys or calling banks up at the time. And so it's very, very difficult to observe this type of behavior that's happening. And so Pew did a great job there, and we used that data and also locations of payday lenders, and we found that these large banks, so we only looked at the 50 largest banks that engage in high to low reordering, are much more likely to be closely co-located with payday lenders. So we thought that was really interesting. And so we see this kind of correlation between this type of practice and potentially, the use of alternative providers such as payday lenders. So then we wanted to get at some more causal evidence. And the way that we did this was we noticed that there were quite a few class action lawsuits against a series of banks over, quite a long stretch of time about high to low reordering. And so we make use of the outcomes of these class action lawsuits. So some of them require that banks just settle via cash, and that cash amount tends to be very small on a per customer basis. Or some of the outcomes of the lawsuits require that banks actually cease the practice of high to low reordering. And so we use that variation in order to establish this causal relationship between this reduction in the use of this practice, excessive fee taking, and demand for alternative financial services such as payday loans. And we find indeed that when banks cease the practice of high to low reordering, that the demand or the use of payday loans declines. And we also see that other metrics of financial health improve for consumers after these reductions in excessive overdraft fees. And so really the main conclusion of this paper and this study is that excessive bank fees can push these lower income households into high cost payday borrowing and sort of damage their financial well-being in the longer term. And really our sort of main takeaway is that when we want to think about financial inclusion, it's really important to really put the microscope on all types of institutions that are operating in this space, and also to try to think about some potentially complex links between different sort of providers of these products. And so when we think about what do we mean by financial inclusion and what are we going for in the United States, we often talk about how we want consumers to be banked. And being banked is probably good, but I think it's important to note that that's not at any cost. Next slide, please. So it's not all doom and gloom. And so while that feels like an extremely negative view of what can happen, in, for example, even in the traditional banking system, which is heavily regulated, there are some really promising trends in overdraft fee practices at banks. So since we published this paper, we've found that there's been an increased regulatory focus on overdrafts since 2021. And so, for example, coming from the CFPB this year, in January 2024, the CFPB proposes a new rule that's going to treat overdrafts like loans and hence will be subject to all the usual requirements of making loans. And in April of 2024 of this year, the CFPB documented that overdraft and NSF revenue in 2023 was down more than 50% versus pre-pandemic levels, saving consumers over $6 billion annually. And at the same time, some banks have completely eliminated overdraft fees. And here are some examples: Capital One and Citibank. And so it really looks like there are some really promising trends of how banks are thinking about the provision of this sometimes vital liquidity to, again, some of the most vulnerable populations in the United States. And these trends seem to be going in the right direction. Next slide. So to sort of wrap up, my thoughts for today, we can see that sort of excessive fees for financial services and misleading terms that are not absolutely transparent can disproportionately affect, again, low-income individuals in sometimes really complex and long-lasting ways. And hence, the appropriate regulation is absolutely vital. It's not only going to do things like promote trust in the financial system and support economic stability, but it's really going to help enhance the overall financial health and resilience of vulnerable populations, which I think is what we're all going for. And thank you so much, Liz.
Okay, well, thanks all three presenters. So you put me in a tough position. You've thrown out the perspective of your research, which I respect, and then I'm going to try to put that in the context of where we live today. So what I'm going to ask you is, based on your research, what steps should be taken by banking organizations? Some of you touched on that. Then I'd like you to also focus on what supervisory authorities, such as the Federal Reserve, should be doing. And most importantly, other influential parties, because we can't do this alone. So there might be some partners out there that you think either the banks and the supervisory authorities should be working with, all right? So we'll go with all three categories. All right, I'm gonna start in reverse order. So Emily, I'm gonna go with you first, and then.
Yeah, wonderful.
All right.
Yeah, it's a great question. So actually, I'm gonna take a little bit of a different sort of view here. So I think that the private sector itself can play a larger and sort of more proactive role. So, as we're all well aware that financial institutions that provide the actual products that consumers use are increasingly focused on financial inclusion. And that's motivated by both, of course, like a strong business case, as all these, millions of households without, access to or using these products, but also the social gains, that now stakeholders are demanding. And I think there could be a kind of broader role for the private sector to sort of build capacity within their institution to conduct more sort of economically rigorous and longer term based research beyond, say, like a typical A/B testing, model of sort of how these products are impacting consumers. And I think that this could sort of provide credibility and trust if done correctly. And could foster financial inclusion. So perhaps there's more of a role for the private sector to play, not just sort of, stating that they are mission-driven on financial inclusion, but really sort of demonstrating that their products really are, helping towards that goal in a way that sort of makes sense in an economically rigorous way.
So you pointed out that one of the barriers might be the fact that these are profit-oriented entities. So things like transparency, you didn't touch on, but I assume we need a layer of transparency here, what the charges are, for example, in the cases you've cited. Are there incentives that you think would go along with that, or that we on the official sector might have to stimulate?
I mean, I think, just generally, I think we should always be aware of this conflict in incentives between this, the profit maximizing aspect and the imbalance between, consumers and the institution itself in terms of incentives and also power and knowledge. I think when we think about sort of financial innovation and how we want to regulate it, I think it's really important to think about how what is this product and what friction is this product overcoming, and is it just really like what is the innovation, what is the fintech here, and trying to really understand that can help understand, are we really expanding the suite of products that we're offering, or just sort of wrapping up something in a different way. And so, yeah, I think just being aware of the incentive mismatch and trying to really think about what is the innovation and what is the product actually doing. But again, I think that research, more rigorous research, can really help inform that.
Okay, thanks for that. So Emily, you helped us cover the private sector, which I'm putting in banks and some of those influential parties. Nikita, I'm going to go to you next. You have a broader perspective, and you frightened me when you said one thing. That's like, we don't even need scores, we can just give them out. So I want to explore that a little bit more with you, but interesting, not frightened, man. I shouldn't have gone as far as that. Jolted me a bit there.
It's okay to be frightened by it. So I'd say from the banking sector itself, I'd say taking a long-term view about consumers, that it does with, say, college students. There's good reason not to give college students credit cards, but they're taking a long-term view that these individuals are going to sort of develop into professionals, and that they're going to get them in on the ground early and get their business, and they may take a hit now, but they're going to grow the business with these individuals. And there's no reason to not think about certain unscored, certainly some unscored consumers who may not have gone to college, but I don't know, may have gone to trade school or have just gone straight to work, and they still have sort of credible careers or stable incomes that are worth investing in as well. And so taking a broader view on what type of consumer is worth taking a risk on in the beginning and investing over the long term is something that banks and so the broader sector can think about. And even as they partner with banks, partnering with fintech firms to create efficiencies and to take on these risks and these innovations, I think that's something for them to think about. Also, between banks and supervisory authority and sort of regulation more broadly, I do, and it's something that I'm like starting to tease out more now, and so it's still a little underbaked, but there are credit programs that exist for them to take these risks, and they're not actually sort of maximizing those opportunities. So figuring out why. Some of these banks are afraid to take on sort of the risk of special purpose credit programs and think that that may expose them to ECOA claims. And so it's encouraging banks to take risk, or at least exploring what are the limits or the bounds of those chances for vulnerable populations. And I think that goes between the sort of regulatory authorities and supervisors and banks together. And then research would be the sort of last part of that. And I think related to research, not CFPB, but CRA credits for all. I mean, there are other things that we can think about more creative that would reward banks for taking innovative steps, and maybe thinking about how we can expand the CRA benefit based on the sort of activities banks and other financial institutions are trying to do in order to bring individuals in. And so I'll stop there.
Sounds good. Demutu, you want to add?
Yeah, so one thing I want to highlight, based on my line of research, is that even though we've been talking about the benefits of alternative data, like if you look at the industry practices, there is research that show that vast majority of lenders are still relying on these traditional variables. It made sense 20 years ago when we didn't have access to this much data and fast computers, but now we have access to vast amounts of data and AI technology. So this has given them an opportunity to sort of really leverage this technology, given the size of the market that is currently underserved. And also, if I may add, one of the key findings of the paper that I presented is that we are not necessarily talking about sophisticated data or complex models. It's very easy to collect, easy to verify data can go a long way, like education in our case, and some other research has found, like rental payment history, utility payments. These can be very easy to collect, easy to verify. You don't need a lot of investments. So these are low-hanging fruits that the banks and the other lenders can start using in their lending processes that could have a big impact. And also in terms of regulators, we've touched on this earlier. So our thing is a case study that shows that these things can work, alternative data, but that's not what is happening in practice. So one of the reasons is that the lenders are concerned about regulatory pushback and violating Equal Credit Opportunity Act. So establishing clear guidelines as to what are acceptable practices. This is easier said than done. We need a lot more research into that. But I think these are the steps that the lenders and the regulators can take.
Okay, so on that score, the regulators have to, I don't want to use the word safe harbor, but signal that, in fact, certain behaviors are implemented by firms, that there will not be a negative outcome from a regulatory perspective. Okay, so safe to act, in other words. Okay, switch a little bit. We talked about banks, we talked about the supervisors, and I have my influential parties in there. Let's switch that a little bit around to the consumer side of this and businesses that might take on, if you will, these alternatives as viable means of payment. So from your perspective in your research, have any of you touched on maybe the sentiments that need to change amongst the customer, if you will, to these products? Do they understand that these are available? Are there ways to educate them on there? I heard a lot of very sound reasons why we need to protect them. But I also heard these are options that are available to them. So let's switch this perspective a little bit from the bank who's providing it, from the supervisor who may be overseeing the bank, and switch that toward the consumer who's actually participating in this. From their perspective, your research. Maybe, Nikita, I'll start with you.
So from the consumer perspective, at least on taking earned wage access programs for an example, to the extent consumers are aware of them and they were sort of advertised in commercials, they're advertised on, and similar to buy now, pay later, they're advertised on TikTok and social media. And so there are pros to that because it's meeting the consumers where they are. But to the extent these products are sort of signaled as low risk, not loan based, it may disarm consumers who may have an aversion to, or at least cognizant that, hey, I should be more careful with a loan. And so the format in which they're introduced to some of these products can be concerning, but it's the question of access and information, getting the information of worthwhile products to consumers requires thinking broadly of where consumers are. If you want younger people to be financially savvy, you might need to engage them on social media. So I would say that, and then they do adopt the products that are sort of trendy, that they're familiar with or that they're exposed to by social media influencers. And so there's a way to engage consumers and inform them that's broader than just the financial institutions on the ground.
Just a quick follow-up, Nikita. You talked about something which I found to be interesting. You said the vulnerabilities, that maybe these individuals are now going to be overexposed, where maybe those who are not as vulnerable have options that they can conceal defects in their credit or just personal and private information. But by putting it all out there, that puts those individuals at a greater set of vulnerability. You want to expand a little bit on that, how we can either mitigate that? Because the tools that are being made available could benefit them, but that vulnerability that you touched on there, I just wanted to explore that a tad more about that. How do you
Yeah.
balance it?
No, thank you for that. So I think that goes to like data regulation, right? Like it's the broad question of how much data is when you're not paying for something or when something is heavily subsidized, that means you are partly the product. And so how are you the product? And if they're using your data in order to give you a low-cost service, are they then using the platform, which some of them do have other partnerships in which on their platform they're encouraging you to use these other financial services. So how is that nudge being used and how should that be regulated? So data and sort of privacy regulation is another component to allowing a consumer to sort of benefit from the value of their data, but also protecting them, or at least informing them that their data is being used in order to influence their decisions.
In the U.S., the consumer, unlike in another jurisdiction, which I won't mention, doesn't really own that data. We don't have a data protection law here or a background in that. So it seems like that's one of the hurdles we'd have to overcome. Do you actually own your data? If in fact
Well,
that's
yeah,
it?
yeah. And even if you don't own your data, like, is there still grounds in the absence of the individual consumer ownership? Is there still sort of a policy grounds on which to regulate the usage of data by market providers?
Okay. Emily, you probably want in on this. You have views?
Yeah, so I think, all incredibly interesting points, and sort of how to sort of promote the use of financial products or safe financial products from the consumer's perspective, I think is really interesting. And I think, I'm going to give a very unsatisfactory, answer here, but I think there's so much more that we need to understand about how and why consumers sort of adopt products. And so social media is a really interesting and extremely current force. And just like was expressed, there's positives and negatives to that. But something that I'm also studying myself is how the use of financial products sort of propagates through social networks, and that can really try to help us understand how we might be able to reach broader communities where there is sort of sometimes these inherent sort of lack of trust or kind of much lower adoption of traditional financial products, for example. And so I think there just needs to be more research in this area, trying to understand for the people who are kind of locked out of the financial system, why has that happened? Is it sort of on the provision side and the supply side? With things like data, now we have more data, and or is it sort of on the demand side? And how do we sort of overcome that? Is it financial literacy, or is it just broader sort of trust issues with the sort of financial system as a whole? And I think that these are really interesting things to study.
Okay, so I heard more research, which to a researcher, that's like telling a kid you want more candy, right? So I can see where that's going.
Right.
Although I do value research, which is why we have this panel today. All right, Demutu, before we move on, I want to give you the opportunity to weigh in.
Speaking about encouraging consumers to use financial product, I like to sort of put a cautionary note on that. Like, so sometimes if you make things too easy, right? So we're talking about expanding access to credit, right? So more credit is not necessarily always good. Sometimes it could lead to situations where you mismanage your debt or you live beyond your means and be more vulnerable to economic shock. So I think we have to be careful when we are trying to make these products accessible to consumers. For one example is, Emily can perhaps talk about this more, buy now, pay later. So we have seen this tremendous growth in buy now, pay later products. So consumers can accumulate several buy now, pay later debt without really noticing the extent of it. And then that if they are vulnerable to any shocks, then that can put them in financial jeopardy because they are now not able to pay their obligations, and that can harm them financially. So I'd like to sort of think like we need to have some sort of a balance, like making things too accessible might also not be, in certain cases, a very good approach.
Just indulge me for a second on this one, Tumutu. The idea that it's too available, which for a large percentage of the people we're talking about, they haven't had that much availability. Your concern is that by making this easy to access, that maybe it's too good for them, or help me. I'm short of saying put constraints on their ability to access it, because that's exactly what they've been subject to for a long period of time. So this balance it's too good, so don't give them too much. I know that's not what you said, but I'm just trying to balance how we might policy-wise factor that sort of thing into our thinking.
Yeah, so I was talking specifically about, like, for example, buy now, pay later, right? So it's really easy if you have a buy now, pay later app, right? So it's just like you sign up and you have already like approved for $2,000. You can just go around shopping. You think, okay, I'll pay it over next year in 4 installments, and then Emily can perhaps talk more about, she has a very nice paper documenting some of the adverse impacts that this buy now, pay later products have on consumers. So that is an example where that has become too accessible. It's really easy for you to sign up for these products and start borrowing from these platforms.
I can appreciate that. Emily, I don't know if you wanted to respond to that last part that Tumutu just covered.
Yeah, actually, so yeah, we actually this paper we studied buy now, pay later, and sort of the access to it and the impact that has on consumers. And I think that, you know, one thing that it's not necessarily being too accessible that is a problem, but I guess we want to understand, is this thing useful for consumers, and can we make an assessment of that? So, you know, buy now, pay later is thought to be a financial innovation, but really what's the friction that we're overcoming, and what is the newness of this product per se? And I think that we still are not 100% clear on that, but really sort of what we found in our study was that actually buy now, pay later, access to new credit for people who may have had no access to credit before, it looks like actually that these consumers or households were using the product in a way to sort of smooth consumption, especially in difficult times. So that looks good. That looks like kind of what you would want from a new credit product. But then other things that we found were that, you know, what sort of in the longer term it looked like was that sort of access to buy now, pay later encouraged people to maybe spend more on retail goods than they would have done before. And we didn't really find many sort of like extreme negative consequences of that. But I think we want to, you know, think about, is this what the product was intended for? Is this what we want? And it's very hard to make a welfare statement about that. So I'm putting all these sort of academic caveats in with this. It's hard to know if people are better off or worse off because they're spending more on retail goods. Maybe they're happier. But did they intend to do that? It's, you know, it's not clear. And again, this just sort of all highlights the complexity of trying to understand what these financial innovations do for financial inclusion. But I just for the you know, the good points and the good sides of buy now, pay later, we did find that there was some evidence to suggest that consumers who had access to it, new access to sort of credit, reduce their precautionary savings motive, and also were able to more smooth consumption during bad times, essentially. And so, but again, there's obviously flip sides to that. We didn't really find much evidence at the time of this debt stacking, which is an obvious concern of all the regulators. We saw that people kind of used buy now, pay later, not as consistently or, you know, as we had imagined we would find in the data. And that all kind of lined up with other external reports. And so, yeah, I think the study on buy now, pay later and the discussion of it just is a classic example of trying to understand how these financial innovations and these new financial products, what are they really doing? And are they useful for consumers, which is part of the idea of what we need to think about when we think about financial inclusion, and does it have the intended consequences? So it's complicated.
Okay, thanks for that. Speaking of consequences, you know what I do for a living. I'm a regulator, so I write rules, and rules can be circumvented. But we have banks that are subject to rules, and we have non-banks that generally are not, right? So in the course of your research, I'm sure you've all seen or come across instances where the regulation itself comes in conflict with our goal of financial innovation. So I'll just open it up. Are there instances where you would share or could elaborate on where you've seen regulation as has impacted banks, and you've seen regulation that may not be as constricting on non-banks since they're not under direct supervision, where you would say regulation of this nature has been complementary and helped financial innovation? Regulation of this sort has worked against us. And we started the day talking a little bit with Vice Chair Barr about CRA, that's one. There's fair lending, there's a whole slew of those that are designed to protect consumers but also facilitate. So any observations you might share with us on if we want to move the bar forward on financial innovation, how the regulatory impact on banks and non-banks is being factored into it? And I'll open it up.
So one area of contention is like when you talk about conflicts and regulations, statistical discrimination that we talked about, right? Statistical discrimination is when we use individualized data and that lead to discriminatory practices. If you start using the school that you went to and or your anticipated income based on your major, that could be correlated with your race or gender. Right? So this could lead to discriminatory practices. So from the regulator's point of view, there is this, so you want to encourage financial inclusion, you want to encourage financial institutions to use these types of data, but also you want it to be fair and not discriminatory. So this is where that you have this conflict. So how do you balance this? How do you encourage the financial institutions to use this variable, but at the same time, make sure that's fair, not discriminatory? So, for example, like regulators like CFPB and the Fed has talked about this extensively, and also I saw recently that some senators have called on CFPB to scrutinize the use of variables like education, the variables that I talked about. So there is a conflict there of like where is the line and how to balance the cost and the benefits of these alternative variables.
Nikita, any thoughts from you?
Yeah, that was going to be part of it, so I'm trying to think of another point beyond sort of the friction with sort of equity and discrimination issues, especially in the black box of AI. But I'd say that some other things, well, it's actually changing. But I mean, there was a time, so this is a positive. I guess there was a time where banks had sort of abandoned or shied away from the small dollar lending space and providing for what would be seen or deemed as high risk or low profitability consumers. And so now some of them are taking greater chances from regulatory encouragement to engage that market. And so I would say increased encouragement and increased sort of at least validation or research demonstrating that mainstream lenders entering the small dollar lending space or servicing low wage or low income or otherwise marginalized communities is profitable, supports safety and soundness. Like figuring out that link would be sort of useful and beneficial, and encouraging them to really sort of step into that market space more forcefully. So, yeah.
Okay, thanks. Emily, anything before I move on?
Nothing more than sort of broad themes. Like, of course, when we think about financial inclusion and to reach all of these households that don't have access to basic services, we need to think about innovation. And because we have these conflicts of sort of incentives generally, then we need to think about regulation. And innovation and regulation are always going to be slightly pulling in different directions. And so, the small dollar loans, for example, I think it's still up for debate in the academic community, whether or not, that high interest loans, whether or not interest rate caps, for example, are the right thing to do. Because, for example, interest rate caps potentially make small dollar loans unprofitable for some lenders with high fixed costs, which means that some people will just not have access to credit that they would have had before. And so maybe it's not the interest rate per se, maybe it's other terms of the loan or other features of the lending practice. And I think that, if I think about the academic literature, there's a huge literature studying this in particular, and I think there's arguments for sort of both sides. But just broadly, these things are going to be in contrast, in conflict with one another. And yeah, the small dollar loans are an interesting example of that.
Okay. Well, we did say we're going to open up the discussion for you in the audience to participate. So we're at that point where I'm going to take questions for the panelists or myself from the audience. We have some mics that are circulating, so if you have a question, you'd like to raise your hand, you can go ahead. Looks like we have one in the back.
Thank you. Great presentations. I want to thank all of you. I think, I hope I'm pronouncing this correctly, Dimutu, hopefully. I think you mentioned in your presentation, as you talked about alternative data, a consumer's digital footprint. I'd love to know a little bit more about what that constitutes. And I'm also interested in our scholar from Georgetown, who graduated from Howard University, so HUHU. Got to give Howard some props there. You mentioned how Upstart has a model that can have a disparate impact on people who attended HBCUs, and I'm curious if companies that are leveraging alternative data are listening to research like yours, and if they're making any adjustments accordingly. Thank you.
Okay, so yeah, thank you very much for the question. In terms of digital footprint, so in our case, what we found are predictive of credit quality in terms of digital footprint are the variables like what type of a device you use to fill out the application. Did you use a smartphone or did you use a computer? If you used a computer, is it a Windows PC or is it a Mac? So it turns out that if you use the Mac computer, you're more creditworthy than the person who used the Windows PC. And also what type of a browser you use to fill out the application. So that may be correlated with income and other variables, right? And so those are the, and also where did you come from? Did you came through a Facebook advertisement or did you come through a Google advertisement or did you come directly to this website? So that also seemed to matter when you are trying to understand the creditworthiness. And so there is some other research that uses German data. That paper found like what kind of email address did you use? Like what kind of an email, like whether you have a Yahoo or a Gmail, that also seems to matter, right? So those are the digital footprint related variables that our paper and other papers have documented.
Yeah, in terms of Upstart, well, there actually had, after that, like, Consumer Watchdog report came out, it was, like, Upstart responded and sort of was explaining how or why. First, they pushed back. It was like, these aren't real applications, and so take it with a grain of salt, was their argument. But then they were saying, well, it's because of the sort of institution's broad sort of statistics on income and job placement, and it's not an individualized, what he was saying earlier, it's not an individualized assessment. And so that is the tension, like at what how aggregate, at what level of aggregation is appropriate when you're trying to bring in alternative data. And are we in a universe now with innovation and billions of data points where it's easier to individualize assessment? And should we be compelling that? And so that is the sort of trade-off that some companies might actually not use education data. They'll use exclusively sort of financial metrics, looking at cash flow data. And so it's choosing the provider and the types of alternative data that they're using. But that is Upstart's sort of sell, and that the education data has helped them despite it having these sort of unintended consequences elsewhere.
Okay, we've got another one in the back.
Good morning. Professor Williams, you mentioned, I think in your presentation, a data point correlating the location of banks that are high to low sorting overdrafts with location of payday lenders. Is that what you said? And if that, can you talk a little bit more about that location data and what that data is and what it might tell us?
Right, yeah. So we have the location of institutions, and these are the data source escapes me. It's sort of like the Yellow Pages, but for the United States, I think. And it's Infogroup, that's right. So Infogroup gives us the location of establishments within the United States on an annual basis. So we use that data, as well as the branch location of the 50 largest banks identified by these Pew studies. And so we just look at the correlations essentially between the location of the bank branch, and we draw radii around the branch of sort of a quarter of a mile, half a mile, a mile, and we find that for the branches belonging to banks that engage in this high to low reordering, that they're just much more statistically likely to have a payday lender co-located in a small radius. And so, we can't think of that as sort of causal evidence. We think it's interesting. It's a correlation. There may be other sort of unobserved factors that might be sort of, leading to this sort of co-location. But that was our starting point for the study. And we thought that it was really interesting.
This is fascinating. Thank you all for your presentations. I'm going to stick with Dr. Williams for a second here. So you mentioned that when banks stopped this high to low reordering, that financial health metrics improved. Can you talk a bit about like what exact metrics improved once this practice ceased?
Yes, and so just to sort of caveat this particular part of the study, so we conducted this study by looking at data from an alternative credit bureau, as well as traditional credit bureau. And of course, it's not 100% overlap, of course, between the people that are going to be in each of those. And so for the financial health metrics, we had to use the people or the households that would be appearing in the traditional credit bureau data. And then we looked at things like amount of debt in good standing. So we saw that increased. So your sort of ability to sort of manage the credit that you already have seemed to improve. And sort of these improvements happened like kind of gradually. So over a period of sort of, let's say, a year, 2 years, 3 years. So we looked sort of 3 years out. And also your FICO score improved. And also access to sort of credit, so credit limits increase. So your access to sort of traditional sector credit seemed to improve as well. So that's what we found.
So a colleague reached out to me who wasn't able to make it today. There's a lot of traffic with the NATO summit. So this is a question for Demutu. So looking at the variables that mattered most, such as education, type of device, job type, it made this person wonder if these algorithms might actually further entrench bias. For example, suppose the underserved, or whatever term you prefer, those people may be most likely not to apply for credit. And thus, for a variety of reasons, but those who actually do apply may be those who are more desperate. And so there's a question of is the fact that they, you're looking at this data like type of device or education, is it potentially training algorithms to look at people at that end of the income spectrum or the credit score spectrum in a way that maybe, may bias the models in a way that could potentially harm future applicants, for those who apply for credit?
Yeah, that's a very valid concern, right? So this goes to that the idea that we talked about, so while when you use these types of variables, right, that could you're using these variables from the pool of applicants that you're attracting, and also another thing that I want to add is so when these kind of models really became mainstream after the 2008 financial crisis, and since then we've had a very stable, low interest rate environment, and the data that we've been using to develop these models, right, are mostly during this period. And so sort of adding to that is, so it's really important to make sure these models work as well during other periods, for example, during an economic crisis period. So if you look at this limited period and see if these variables work, maybe it works during these stable environments, but then if these do not work in different economic environments, that could have financial stability implications, and that could impact a certain subset of the population that you're attracting, and then if those people are in trouble, that can have financial stability implications as well.
So I want to follow up with Upstart as well. We're going to just keep picking on you. So Vice Chair Barr started off, and he talked about the importance of when you're using data that there's a clear connection to creditworthiness. The unique nature of the way Upstart got its no action letter, and for 4 years had the CFPB saying, help, this is good, keep going. It had independent fair lending monitors to review all of their work. It had university professors like yourself. They're not a huge company. I mean, they're listed, but they're not a huge company. But here you had a lot of effort spent on people looking at their data, proprietary data. Researchers like yourself having to say, this is sort of what we know, but I can't tell you what the black box is. And then the independent monitor saying, hey, here's the problem. You're using specific university. We believe that by doing that, you're discriminating against people who went to HBCUs. Is there a way to do this differently? They go back to their black box and say, well, let's just use college degree and level of education rather than the place you went, and that way we get less discrimination, but still about as much information from the model. That was a lot of effort for a very complex model, as opposed to a small number of firms that are out there with very, very transparent models, using just 4 or 5 variables rather than 1,600 variables. How much effort should be made to allow that kind of work to happen? We want innovation, but is the extra 2 or 3% more that they have worth all that extra work and keeping Art and our regulators busy? So for all 3 of them.
Yeah, so that's a very good question and a difficult question to answer. So this is a concern, and so I really think we need to sort of look at a long-term time frame, right? So we need to establish a good balance into what works and what doesn't work. So where is the line actually, right? Whether you want to use the school that you went to, or you want to use the education level of the person, right? So for me, like for anyone to answer this question, we need a lot more data over a long period of time, and we need to track these individuals over a period of time, right? So we have to balance what the cost and the benefit. So there is a benefit of using those variables. At the same time, there is a cost to that, right? So one thing regulators can do is perhaps encourage these institutions to make the models more transparent rather than like leaving them as black boxes, and also, like Art mentioned earlier, right, encouraging them to experiment using some things like sandbox with limited regulatory repercussions, so that give them some room to be creative and innovate will help us. But I don't know the answer to that question. I think nobody does, but we need to sort of collect more data over a long period of time to see what benefits are sustainable, what are unintended consequences, and things like that. So I think we need to wait a few more years to get a definitive answer for that question.
Okay, all good things must come to an end. We are at the close of our allocated time for this panel, but I'd like to tell you there needs to be more research. You convinced me of that, and we should work jointly on that, by the way. And in addition to that, I'd just like to thank each one of you for not only just anticipating the types of things that we need in this space, but you acted on it. And so each one of you brought a different perspective today. We very much appreciate you sharing that with us, and we look forward to working with you in the future as we go down this path together. So if you just join me with thanking our panelists for this first panel, we'll wrap up this session. So thank you very much. Okay, we have
their seat. And so we'll go ahead and get going with the next session. So my name is Mark Manuzak. I'm an Associate Director in the Division of Reserve Bank Operations and Payment Systems here at the board. And I'll be moderating this session on payments and financial inclusion. The speakers we have for this session are really excellent. It's Scott Hsu and Dorothy Delort. I'll spend a brief amount of time introducing both of them and providing a bit of their background. Then I'll give them each an opportunity to make some opening remarks about their thoughts around payments and financial inclusion. I'll ask them a few questions before opening it up to the floor to let you all ask them some questions as well. So as I said, our first speaker is going to be Scott Hsu. Scott is an associate professor of economics at West Virginia University. At West Virginia University, his research and teaching focuses on macroeconomics and monetary economics. And there's a particular emphasis in his research on fintech and its effects on money, payments, banking, and household finance. Prior to moving to West Virginia University in 2018, Scott worked at the Federal Reserve Bank of Boston for nearly 20 years. At the Boston Fed, Scott was the director of the Consumer Payments Research Center, where he led the creation and development of the Survey of Consumer Payment Choice and the Diary of Consumer Payment Choice, both of which have provided really invaluable insights into how consumers in the United States adopt and use different payment methods. Our second speaker is Dorothy Delort. Dorothy is a senior financial sector specialist in the Payment Systems Development Group at the World Bank, where she's been on staff since 2012. At the World Bank, Dorothy has been involved in providing technical assistance to a variety of countries on national payment system reforms and the development of financial market infrastructures and retail payment systems. Prior to joining the World Bank, Dorothy held positions at the Banque de France and the European Central Bank, as well as having a brief stint on secondment here at the Federal Reserve Board. And I believe Scott also was at the Federal Reserve Board back in the 1990s, so welcome back to both of you. So thanks to both of you for participating in this event. As I said, to start, I'm going to provide each of you an opportunity to give us some opening remarks. And I think what we'd be particularly interested in hearing is the connections that you see between payments, innovation in payments, and financial inclusion, both in the United States and in other parts of the world. How important are payments as an aspect of financial inclusion, and how do you think about that connection? So I think we'll start with Scott.
All right, thank you, Mark. It is a privilege to be here and to weigh in on this very, very important and complex topic. I'm going to speak from some notes without slides, and feel free to ask questions later. All right, so I want to talk about how we get from payments to financial inclusion by giving you a quick overview of what I call the transformation of payments, which is actually much more complicated than you might think. But we need to start with a little bit of abstract theory, and there will be no equations, so don't worry. The definition, what is a payment? Payment is, we probably all know what it is, but a payment is just simply the exchange of one asset for another. That asset might be a good or a service, but originally, we did this without money. It was called non-monetary exchange. We traded things, one good for another. It was called barter, really costly. Double coincidence of wants was a problem. So money was invented to make that whole process cheaper and simpler. And so we could simply take money and buy stuff instead of other goods and services. But money itself became more complex over time. It started off with currency, coins and bills, and then it moved into bank accounts, which became more and more complicated accounts over time. And more recently now, there has emerged things that we might call non-bank accounts, which are actually mostly connected to bank accounts in the background, but nevertheless are being managed by non-banks. Well, that's not the only way we could make payments in theory. We can make payments with debt-based instruments, an IOU, a credit card, literally any kind of extended payment plan, a layaway, payment plans, rent to own, those sorts of things. We could use secured credit risk, We could use a house or a car to leverage to make payments as debt. And we could use unsecured credit, which is the classic is credit card loans. But buy now, pay later loans, personal loans can work as well. Finally, there's equity-based payments where we literally trade an asset for the payment. And these are usually non-monetary assets. So when I first got interested in this, a perfect example, this is a home equity line of credit. You can write a check, pay for it out of the credit or the equity of your home. When I first got into payments, my first question was, why don't we just all have a S&P 500 indexed fund account from which we pay each other with? Well, there's a lot of reasons for that, tax reasons, other things. But I always looked up to one of my former colleagues at the Boston Fed, a high-ranking colleague who was not low income, not low wealth, was very intelligent, who used to brag that he didn't have a bank account and never needed one. Well, what did he have is he had a Fidelity money market fund account from which he paid with checks, and he had a credit card, and that's all he needed to survive in life. So it's interesting how there's been a transformation of financial markets, monetary and non-monetary financial markets. There's been a transformation there that has undergirded the payments transformation. Now, how are payments related to money and accounts? Well, payments are, as Nobel Prize laureate James Tobin said, they're a derivative media of other types of assets. What does that mean? That's a geeky professorial comment. A derivative media is it's a thing that's used to communicate to the parties between the buyer and the seller of where the asset's going to come from and how it's going to get communicated and settled. So a payment instrument could be associated with currency, could be associated with a bank account, could be associated with a debt account, or it could be associated with an equity-based account. So the payment instrument is the thing that we authorize, clear, and settle stuff with, or set up the settlement. So these payment instruments are things that people have to consciously adopt. So that much of my research is about watching how individual people choose to adopt cash, choose to adopt credit card, choose to adopt online banking bill payment, choose to adopt Venmo or Zelle. And the overriding conclusion of this is people are a lot smarter than we think they are. I want that to settle in because I think the people that we're trying to help with financial inclusion are often viewed as not having a lot of street smarts or intelligence or ability to manage their money, but we find that that's often a mistaken perception. People adopt and use instruments that satisfy their perception of cost, security, record keeping, timing, other kinds of things. They factor into their decisions the choice to use those things, and those things have become more prevalent in the United States and more powerful, and so there has been, in a sense, an increasing access to financial markets. Second piece of the transformation is the diffusion of technology. This is entirely separate from payments, but payments is very much dependent on it. So all of economics has been affected by the move from the physical realm of paper and metal into the electronic realm or the virtual world. This has taken over half a century to do. It's become increasingly complex. But some of the things that have happened since the first Diners Club credit card, and if there's anybody here old enough to have had one of those, I'd love to talk to you, because the grayness in my hair doesn't quite qualify me for having that card. Anyway, that was the beginning of the electronic movement, and then it moved into electronic funds transfers, which consumers didn't know anything about, but banks were learning how to communicate with mainframe technologies behind the scene. In the 80s, it became more clear to consumers that if I adopt an ATM card, it's going to be a lot cheaper to get cash out. Many of you don't know that when I was young, you had to get to the bank by 6 p.m. on Friday, otherwise you were having a bad weekend because you couldn't get your cash, right? Well, that went away with ATMs, and then somebody said, hey, what if we give merchants these electronic terminals where you could swipe your ATM card and make a payment directly and even get cash back? So that was another technology that advanced. And of course, the internet changed everything in the 2000s because now everything was available to everyone. And the old market, where we used to have to go to town and bring the ox and the corn and make a trade, now you could do this instantly online with everybody. In fact, in theory, you could do barter on eBay. But PayPal decided, no, I got a better idea. Why don't we be your payment service provider for this phenomenal innovation? And so banks caught up with that too, and there's online banking and other kinds of things. Well, mobile phones weren't to be left out, so cellular technology developed, and lo and behold, they said, hey, you know what? We can help Kenya skip from hard cash to electronics today. And M-Pesa was born. And of course, those technologies advanced throughout the world. Here in the US, like Stripe and Square, Apple Wallet, other kinds of, and of course, Venmo. But the ultimate emergence of electronic payments has been also the most controversial, and that's cryptocurrency, with the emergence of Bitcoin, which originally was intended to be an online cash system that didn't require ATMs anymore, but could still act like cash. And importantly, it provided the opportunity to circumvent third parties, like banks. And that is where a lot of the controversy comes from. Well, in the 2020s, we're now at the last mile of this electronification of payment systems. Bank accounts are still, there's 5% unbanked, but there's 95% banked, and that's a big increase over the last 20, 30 years. There's essentially been a near elimination of float, and with the real-time payment systems that we have now, the FedNow, that's basically gone. And central banks, like the Fed, are considering central bank digital currencies. So those two lines of diffusion and innovation and transformation, both in financial markets and in payment systems technology, where the system is everybody involved, the buyer, the seller, the financial intermediary, the payment service provider, the processor, those two transformations, those adoption of technologies and money, which follow the usual diffusion patterns that we see in economics, those two things come together in the payments world. And then they also have now spawned what we call fintech. And fintech, to be short, is financial technology that doesn't involve banks. And it is yet another interesting competition for the banking industry that fintech providers are using all of the innovations and the technologies and the variety of finance. They're using that to provide services that, I don't mean this in a critical way, but that banks have been lagging in providing. The customer service aspect of fintech is what is helping it win its way through. My timer doesn't work, so I still have 10 minutes, apparently. No. Fintech companies are providing things that banks kind of missed out on providing in terms of customer service. Great example is one of my best friends at the Boston Fed. One day I was telling him how we were adding to our survey, the adoption and use of Venmo, which Joanna Stavens and I both had teenage children. They were using it. We didn't know what it was, so we had to find out. And so I was explaining to my other colleague, there's this thing called Venmo that we're watching, and he goes, "What's Venmo?" Because he didn't have teenage kids, but he was older. And we said, hey, this is how you can pay back people at lunch without using your bank. And he says, well, his first thought was, how come banks don't offer this? And I said, well, just wait, because I had a bet going on that after Venmo reached about 7 or 8% adoption, the banks were going to come out with their alternative. And sure enough, we got the survey results that Venmo hit 9% adoption, and a month later, Zelle was announced. So this is the kind of competition that's going on between the non-bank fintech sector and the banking sector. Now, one thing that is important to understand about this is fintechs don't have access to depository accounts because they're not depository institutions. But much of the business plan that's necessary to generate enough revenue for payments provision requires ownership of a bank account. So fintechs are sort of at the mercy of banks because they make agreements to put their money in their account, but they can't exploit the revenue sources that banks have. All right, so that all brings us together to what is financial inclusion from a payments perspective. Well, CPMI says simply, financial inclusion may be interpreted as having access and using the type of financial services that meet users' needs. I think Emily's definition was also an excellent one that put some more qualitative value to that. But it's getting into the payment system, and it's then using the payment system. So in the US, getting access to the payment system isn't that hard. Everybody has cash. Now that might not be the cheapest way to do things, but the vast majority have a bank account or a prepaid card account or some intermediated account through a fintech, right? So the access is not really so much the issue in the US, but the use of these technologies is still quite lagging in the US, and the use of those technologies requires or depends on a lot of really important things. Price of the service, the quality of the service, the transparency of the service, the ability to understand what it is, the suitability to the user's needs, the convenience and ease of use, the security and the risk. All of these things are determinants of how much people use these payment systems. And so the effectiveness of those things is the ultimate measure. All right, lastly, I think I'm supposed to give you an idea of what I think is the importance of payments in financial inclusion. And I think I want to do that this way. Let me cite again the CPMI that says payments and payment services are in their own right an important part of the overall package of financial services. It's not the only part, but it's a part of it, all right? So what are the parts of financial inclusion? It's when you stop and think about it, it's an amazing number. Labor market to generate income. You have to be included in the labor market to have income. The payments market, obviously, so that you can buy consumption and make investments. The credit market, so you can borrow and pay for consumption and investment. And asset markets, so you can save. Legal markets to protect rights and enforce contracts and such. Education markets, so that you can learn how to manage your money. And some might even add efficiency in markets, both in private and in public policy. So here's my final answer. How important are payments? Well, there's three answers. One is they're invaluable. If you can't pay for something, you're out of the financial system. Okay? That is probably not the most valuable one for the US. Roughly speaking, payments is equal to any of those other components that I would mention. But the thing that occurred to me that I'll conclude with right now is I thought about what's happened over the last 50 years in terms of adoption and use of a wide, breathtaking variety of payment systems and innovations in financial markets and money. And I say, how have we done in terms of broad measures of financial standing? And the answer is, it's during those 50 years in which the US was providing increasing inclusion through payments. It was during those 50 years that income and wealth inequality continued to increase strongly and steadily. That immediately, to me, raises the question, is access to the payment system solving the ultimate problem that we worry about with financial inclusion? And it appears to me the answer is no, that there's something more important than just the access to payments that is the solution to improving financial wealth and health of people.
Thank you. So I'm also going to take you on a travel, but not through the history of payments, but more outside of the US. And what I want to do is try to give you an overview of financial inclusion broadly in the world. So what we know already is that financial inclusion, defined as access to a transaction account. A transaction account is an account by a regulated, supervised, and overseen financial institution. It can be a bank or a non-bank. So financial inclusion and account ownership vary widely across the world. It's 6% in South Sudan, and it's almost universal in Canada, in Germany, in the UK. What we can also say is that financial inclusion has seen a lot of progress in the last decade. The global account ownership rate is now 76%, and it was 51% 10 years ago. And this is based on the World Bank Findex data, which is a survey of 123 countries for financial inclusion data. Account ownership in developing economy, though, is still only 42%. It grew from 42% in 2011 to 71% in 2021. So a more than 70% increase. So definitely a lot of progress and financial inclusion on the rise globally. I really agree with what Scott just said, that it is cost and convenience that can drive financial inclusion. So when we see a product, a service that will meet the needs of the unbanked, they will use it. And this is exactly what's happening with mobile money. Mobile money has become a very important enabler of financial inclusion, especially in sub-Saharan Africa, and especially for women. It's a driver for account ownership, for account usage through mobile payment, saving, and borrowing. Another point that I want to make is that COVID has been has catalyzed growth of usage of digital payment. Why? A lot of governments wanted to send relief payment. And we know in developing countries, governments are the major payer and the major user of the national payment system. And so there's been a lot of push and incentives for people to open a transaction account in order to receive these COVID payments. There's still a lot of room to grow. Millions are still unbanked. As shown here, you can see agricultural payments received in cash only. So there's a lot of work still to be done. And more than half of the world unbanked adults live in 7 economies. India, China, Nigeria, Indonesia, Pakistan. Based on the 2021 Findex data, apparently 5% of the Americans, about 30 million people, were still unbanked. But even in these countries, you can see a lot of innovation happening. And I was recently in China, and it's very impressive how non-bank are really transforming usage of payments and payment services in China. Basically, they're leapfrogging. They're going from using cash to using mobile payment and not using cards. So they're leapfrogging and just not using cards. So we see major transformation, and not all countries in the world are following the path that the US has followed. So world payments and financial inclusion. So I'm going to use the CPMI World Bank payment aspect of financial inclusion framework, and I think Scott has already mentioned some of the aspect of it. The vision is that all individuals and business should be able to have access and to use at least one transaction account operated by a regulated payment service provider. to perform most of or all of their payments need, to safely store value, and to serve as a gateway to other financial services. And for me, this third point is really the key, is that payments are often the gateway service in order to access other financial services. And it's very true also in this country using mobile money, is that they're building new credit history based on their mobile money transaction. Even though they don't have a bank account, they can still use their payment transaction data in order to build a credit history and access credit, access saving and insurance. So the PAFI framework, basically, it's this house that you can see, and it identifies a number of foundations and of levers that could enable universal access to and frequent usage of a transaction account. So the foundation are, of course, the legal and regulatory framework, the technical infrastructure, but also the policy, the public policies in relation with financial inclusion. And the levers are the design of the transaction account and payment products, access point, and we see that outside of the US, the concept of an agent that will be able to give you access to mobile money by offering cash in, cash out services and maybe other services. Awareness, financial education is a very powerful lever for financial inclusion. And the last one is leveraging large volume recurrent payment flows. And not only government payment, also remittances. We see that in a lot of countries, remittances, so payments sent by migrant workers, are very powerful to further financial inclusion, both in the sending country, where the migrant worker work, but also in the receiving country. So this PAFI framework has been enriched to take into account the fintech developments relevant to payment aspect of financial inclusion. And this is this PAFI fintech wheel that you can see here. And there's a number of innovation that contribute to the role that payment can play for financial inclusion. But I want to focus on a couple that we see having a transformative impact in many developing countries. And the first one is fast payment. And fast payment, we all know are payment that can be defined as allowing for real-time transfer and immediate credit to the payer, to the payee account 24/7, 365 days. And we see really fast payment in a lot of countries transforming the usage of payment instrument and really deepening financial inclusion. Why? One of the main constraints for financial inclusion in many countries is that a lot of merchants are reluctant to accept electronic payments. They would rather you pay in cash, because cash they receive immediately, and they don't have to pay a merchant discount rate. They don't have to pay a fee to a credit card company and wait for 3 days. But in Brazil, for example, it used to be the case that merchants had to wait for 15 days before receiving the payment for cards payments. So when a merchant can see immediate credit on his or her account and no fee, very often no fee associated to receiving that payment electronically, he will see the benefit. And as Scott said, he will see that there's no cost. He will see that he will save money compared to cash because he does not have to travel in order to be able to put the money on an account. He does not have to risk in terms of security of transporting that cash. He can also more easily pay his own providers and his value chain. We also see that fast payment offer value-added services, especially in terms of aliases and the fact that you don't have to remember that very long account number in order to send a payment. So fast payment in Asia, PromptPay in Thailand, of course Alipay, WeChat Pay in China, but more recently Pix in Brazil are really transforming usage of payments. And we see them as a very critical enabler for financial inclusion. I've listed a few examples of success story for fast payment. Brazil is one with Pix. India is one with UPI, obviously, and we've seen major progress in financial inclusion in India in relation with UPI, in Pakistan, in Thailand with PromptPay. Another innovation that I want to flag is, and it's not mentioned here, it's the usage of QR code. The fact that you don't need this expensive piece of equipment in the form of a POS to be able to accept electronic payment has been a game changer in many developing economies, because anybody can have a passive QR code printed on a piece of paper. And it's very funny in Asia, and I'm sure you've experienced this, that you see people that are begging or that are in temples that are begging for offering. They have a QR code. They almost don't take cash anymore. So QR code have been a game changer for electronic payment acceptance especially by small merchants. So more than 100 jurisdictions have already launched a fast payment system, and I'm sorry, maybe the US should now be included in the list of countries that have a fast payment system.
I think we are.
Well, if you're white, you're not.
No, but we're blue.
Ah, you're blue, so you're good. So, and it's been really a game changer. And as the World Bank, when we work on financial inclusion, one really strong entry point for us is working on the national payment system, is legal framework, its technical infrastructure, and we are supporting a lot of jurisdiction in launching this fast payment system now. So I think I'll stop here.
All right, thank you, Scott and Dorothy, for those excellent remarks. Very good perspective, both on the developments over time in the United States and then across countries from Dorothy. Both of you relied on the CPMI definition, CPMI World Bank definition of financial inclusion from a payments perspective. And in some sense, that's a pretty narrow definition. In the previous panel, we heard people talking about a lot of other considerations, access to credit, different types of financial products. And one could say that payment-focused definition is somewhat, it's not that aspirational. It's not that broad. Another perspective would be that it's very foundational, that it's just a baseline, certainly across countries, which can vary dramatically in terms of whether any of those other financial products are even available. But I was wondering if both of you could comment a little bit, and Scott, you did this a bit at the end of your remarks, about how you think about that definition of financial inclusion and payments as opposed to what might be broader or alternative perspectives on what it means to be financially included. And so maybe Scott, maybe we'll start with you.
Sure. There we go. Thanks. Well, I have 4 challenges that I see. I don't know if I'll have time to talk about all of them, so let me just summarize them first. One is to solve the free service challenge or paradox. Second is to delink payments and credit. Third is to reduce the complexity, which is a double-edged sword about payments. And the fourth, which I certainly won't have time to solve or talk about, is to derive an optimal interchange fee for two-sided payments markets. Bob's laughing. You know I won't get to that one. Let me go to the one that I think is actually the biggest 800-pound gorilla in the room. And it's not payments per se. It's about banking and it's about fintech. So first, there's a free checking paradox. Free checking isn't. You all know I'm telling the truth, right? But before the bankers get mad at me, free checking shouldn't be free. Why? It's an economically valuable service to take deposits, guard them, and make payments. So banks need to get compensated for that service. But unfortunately, in the early 80s, they got backed into a corner through the deregulation of accounts and the race to the bottom for account fees. And they've been stuck there ever since in what economists would call a bad equilibrium. There won't be very many bankers that will tell you this, but in my discussions with bankers and payment service providers, they'll all tell you the biggest problem they have from a transactions account basis is it's impossible to make enough money off of low-value deposit accounts. And there's a lot of them because half of the population is below median income. So this needs to get solved. How does it get solved now? Well, banks charge quote-unquote hidden backdoor fees, unexpected fees at the very least from the account owner's perspective, and that makes the banking experience costly and unpleasant. That's got to get solved. It's being pushed by various regulators, but even Chase CEO Jamie Dimon was quoted last week in the Wall Street Journal, you probably all saw it, said, if we lose those backdoor fees, you're paying for your accounts. Well, guess what? When I was in college in California in the early 80s, Bank of America charged me $10 a month and 10 cents for every check I wrote. And nobody complained. So I think we have to solve this free checking paradox and help banks out of that bad equilibrium. They may not be able to do it themselves. So regulators may need to help and private sector may need to help with that. Second, not to be outdone, fintech has fallen into the free app paradox. So they give all their services for free, and many of their services are fantastic, but they're not generating enough revenue to make it a sustainable enterprise. And as I said before, part of the reason is they don't have access to a depository account to internalize the revenues that go along with that account. So somehow, the fintechs who have great customer service, great innovation and ideas, need to play better with the banks who have, let's say, less of those things, and find a way to make it work for everyone. Challenge number 2. Adoption of credit cards has now risen to almost 82% in our surveys. It was in the low 60s not that long ago. So you might say, hey, that's more financial inclusion. But in a paper that just was published in the Journal of Monetary Economics, Scott Fulford and I show that the median consumer in the United States uses about 50% of their credit limit from the beginning of their adult age. 50%. That number does not go down below 40% for the median consumer until they're in their 50s. That means we have lifetime revolvers who are paying high interest and who have much lower consumption profiles because of it. Now, do you say, well, they got access to a credit card, and if they have unexpected expenses, they can use that. But what if they self-insured themselves? What if banks offered them a $2,000 savings account instead of a $2,000 credit limit and said, hey, when your tires go bad and you need $700 to pay for that, and by the way, as a former auto mechanic, that's not an unexpected expenditure, that's an unplanned expenditure. You take the $700 out of your self-insured expenditure savings, And then we work to help you pay that back. So this is all boiling down to credit and payments, if you can manage them, are fantastic and wonderful. But for most of the people, those should probably be separated and handled holistically as part of a month-to-month budgeting plan. So that means more savings. All right, lastly, and I won't take any more time on the interchange fee, the credit card market is a mess, even to people who understand it. It is so complex. There's so much information that consumers, merchants don't know, and it's only gotten more so. And so there's a role for regulators and policymakers to help make that information less complex so that people can make better discussions or better decisions.
So Dorothy, I don't know if you want to add anything from an international perspective.
So a lot of the challenges that you mentioned are also apply outside of the US, especially in terms of finding a viable business model for payment services and for fintech. And you have to take into account that, for example, in India, the government subsidizes UPI so that it's free, because they've seen payment as a tool in their financial inclusion agenda. So they made the political decision to subsidize so that it's free for users. But I agree with you that it's not everywhere in developing economies that government can subsidize payment services. And so finding the equilibrium between the cost, being willing to pay something for payment services, then you need to have value-added services. So these challenges are also there in developing countries. Those associated with cards are less there, because I think cards are very specific to the US and to Europe in some sense. There are other challenges in developing countries. One obvious one is lack of network and coverage. Not everywhere can you access the network. Another one is lack of ID. A lot of these mobile payment and these new digital payments rely a lot on the way you are able to do your KYC. And we see that UPI in India leverage Aadhaar, the ID system, just like in Pakistan, it's Aadhaar that's been a big enabler. So you have very often this connection between network, ID, and payments. And this is what we call at the World Bank DPI, digital public infrastructures. In order to enable access to these payment services, you have to have this network, you have to have this ID. Then there are some challenges that we see rising with fast payment, and it's fraud and it's cyber risk. And I think it can also apply to the US. We see that with fast payment, there's a lot of fraud, so it's very difficult for providers to be able to manage this fraud when the payment is immediately credited to the beneficiary's account. Which is pushing in the good benefit side of this is that it's pushing for a more collaborative approach, a market-wide approach to collaboration on fraud and cyber risk in a lot of countries. But we see also a need for a number of financial authorities to become more proactive on cyber risk. And sometimes they don't have the resources that you have in the US. So this would be the challenge that I would see. Mark.
All right, so I actually think we might open up to the floor at this point. Scott and Dorothy both provided a lot of interesting perspectives, maybe some controversial remarks, and I think it might have some reactions from folks in the audience. So I think we'll open it up and see if there are any questions, and if not, I'll ask some additional questions myself. But Bob, go ahead.
Scott, you hit on something I don't think we talk enough about, which is cost of creating an account is the cost of acquiring the customer, the technological cost of opening the account, the customer service, and the compliance cost. And more than a decade ago, we did some work on prepaid cards with a partner that's in the room. And what we found is that half of the portfolio of cards didn't generate enough volume to recover any reasonable assumption about the cost of getting that customer and opening that account. And the whole program was being funded by the other half of the distribution. And it sounds like you would say the same is true of bank accounts. When we talk about instant payments and all of these innovations and trying to get to 100% adoption, we have got to address those fixed costs. How are those fixed costs going to be amortized when a significant share of the population will never transact enough to be able to recover those costs? So that wasn't a question, that was repeating what you said.
And I would agree. And willing to talk about it more later. Yeah.
Thanks. This question I think is mostly for Dorothy. It was interesting that a lot of the benefits when you were talking about fast payments are not actually about the speed of the transaction, but rather the other types of infrastructure, the value-added services. Because I've been thinking about financial inclusion in the FedNow context and struggling to come up with what is something that we can enable with FedNow in the US context, which already has a pretty, to Scott's point, a pretty extensive access. The access problem is small here. So then what's the value of the real-time payment versus the other forms of infrastructure using ACH more effectively? Things like, I've heard, employers can pay you daily. Employers can pay you daily now, and it just takes 3 days to hit your account. So there's other forms. And so interested to hear your perspective on where's the value of the speed of the payment versus those other services.
So our experience is that people that we see in emerging economy, they place a lot of value in the speed, in seeing immediately the credit, because even some people that can't read, they will have a voice box in their small stall or shop saying that the amount has been credited, so they can immediately know the money is there. They don't have to bother about it, just like putting aside cash. So the visibility, the immediacy of the payment, and also the fact that it's mostly free, which might be an issue in the longer term. I fully agree, but there's no right. And the fact that it's associated with a very easy way to accept payment, the QR code. So it's a combination of all of this that we see as very very powerful and explaining a fast payment system. Another element that we don't discuss is the cross-border dimension. We know cross-border payments are slow, opaque, and expensive for many countries, including maybe the US. So we see a lot of initiative to interlink fast payment system, starting in Asia through Nexus, the BIS Innovation Hub project. So for many countries, having a fast payment system is also a way to facilitate cross-border payments. And it's a major argument. I just would like to come back on shortly on your point, Bob, on I see also a danger with the rise of crypto in saying to people that now they should pay to have money in a regular bank, because this money is still being used by banks for transformation and to make money out of it somehow, even if they don't charge customers. And if people say, now it's getting expensive to have my money in a bank account, maybe I should use only crypto, this could be a risk for the banking system. So we have to be careful in how we manage also this communication around the fact that you may have to pay for your banking account.
I'm going to moderate. So Scott, you can respond to that, but I'd also like to hear your thoughts about fast payments, instant payments in the United States. Yeah. But if you wanted to respond to what Dorothy just said.
Yeah, if you don't mind, a friendly amendment to that argument is I do think if banks gave some thought to redesigning their business model, where their revenue project comes from, and that's going to require making it clear to the customer that the service that they're getting is valuable. None of us complains about paying Netflix every month. None of us complains about our internet service provider. We might complain about the price and the speed and whatever, but we don't begrudge paying for that service. The vast majority of people that are in the free checking paradox end up paying way, way more in fees. Those overdraft fees that Emily was talking about, that is a terrible thing, and that is actually, when you do the math, it's logical for a low-income person to go get a payday loan at exorbitant interest rates because the implied rate of an overdraft fee on a $100 bank account is phenomenally higher. So it just takes rethinking and saying, hey, how can we actually help the customer be not only financially included, but financially thriving and successful? And if the financial system would take that approach, not how many fees can I generate or how much interest can I earn, but how can I help the customer grow, that is the fundamental piece of our thinking that has to change. I'm sorry if I'm getting passionate about it, but I've been thinking about this a lot since I left the Fed. As far as fast payments go, my colleague Joanna Stavens and I, while we were developing internally this Fed payments, we wrote a paper that tested to see how important the speed of the payment, and it's not really how fast the payment gets made, because the payment gets made instantly. It's really the settlement, meaning on the back end, when do the assets get exchanged? That's what is fast in a fast payment system. Now, it's great that it happens fast, but then if you go like, oh, well, I didn't want to do it, you can't undo it. So there's a new risk that's introduced by completely eliminating float. And we found in the US that the speed of that payment, that settlement speed, was not very important among all the other things that consumers were concerned about for US payments. And also, there was very few consumers who were in the position of needing a last-minute payment to avoid a late fee.
Hi, thank you both for very interesting presentations and your very interesting comments. Going back to something that you mentioned earlier, you talked about needing to change our thinking with, thinking about the way we think about fees and things like that. So I wanted to ask both of you broadly, with these new sorts of payment technologies, whether it's fast payments, mobile payments, CBDCs, cryptocurrencies, since payments depend on networks, to what extent does thinking about factors that influence adoption, the narratives of hey, this is a really great thing that will really help you, versus, oh, this is something that is completely useless and adds no value to my life, therefore I'm not going to use it. How much do those sorts of narratives factor into our considerations of what technologies end up being adopted and what ends up being practically useful instead of just theoretically helpful?
Well, that's a tough one, because what we see, you could wonder why would people even use crypto. Very often we think it's a solution in search of its problem in many countries, but still people will use it. Some people because they don't trust trusted parties, they don't trust banks, they don't trust central banks. So some people, because they just want to try the new technology, they want to do something on DLT and on blockchain. So sometimes I have a feeling this is a runaway train. It's going to happen anyway, even if we feel we might not need it. It's happening anyway. So we have to adapt to it. For the rest, I strongly believe in cost and convenience. Well, if you offer people something that is very easy to use, rightly priced, they will use it. And if they don't use it, maybe you need to include some communication around it, some financial education in some countries. But again, we've seen people that can't read, that don't have a smartphone, that have a feature phone, and still they manage to use mobile money. So I think these are the strong incentives.
I might answer it a slightly different way, which is that I don't think the systems matter at all. Not that your question's not a very good one, but I think the reason people thrive financially is that they manage their money well. And that is being done basically for everyone outside the very, very, very rich who have their own financial advisors. That's being done by every person individually. And there's a lot more apps, there's a lot more software, there's even banks provide personal financial management tools. But it's always left to the customer. And many people are not good at it. Many people don't like doing it. And even high income, high wealth people make small mistakes along these lines. They need the help, they need the collaboration of their financial institutions. And that is some kind of a discussion that doesn't seem to ever get taken up and acted on. Let me give you two examples. One was when cards were being used at gas stations. The gas stations, they initially charged the account $1, all right? And then once you filled up, then they charged the full amount. Well, if you didn't know how much was going in your tank and you only had $34 in your account and you put $40 in, guess what you had? An overdraft. Well, the financial system had the electronic know-how and wherewithal to stop that from happening, but the system was not designed to help the management of money. A second example is, rather than ordering the payments to overdraft, they could have ordered them to avoid the overdraft, and they could have extended to the customer and said, hey, here's a better offer. We'll do something like European banks do and say an overdraft is just a short-term credit and charge a small amount of interest instead of $35. Banks could have made that bargain instead of just maximizing the ease of making money off of people's mistakes.
Okay, I think we have time for maybe one more. I see one back in the back.
Both of you talked about access to the payment system as a key on-ramp to financial inclusion, but we're also seeing concerns about fraud and scams really tightening or potentially tightening access to the financial system. I mean, whether it's government impersonator scams, which are rampant, or other types of text messaging scams that are rightfully leading both financial institutions and regulators to take a look at who is let into the financial system and how. And what do you think that might imply for inclusion, and are there solutions to get the balance right?
So first of all, we've seen the benefit of non-bank entering the payments market. So overall, I think the benefit from non-bank is clearly there, because in many countries, the banks were not offering those services to the unbanked. But we've always made it very clear that non-banks should be licensed, regulated, supervised, and overseen. So it's not because you provide access to non-banks that you have to relax your requirements, and especially in terms of security. It's a challenge for many central banks and financial sector authorities to know how to supervise those non-bank payment service providers. But the fraud very often, especially for social engineering, it does not originate from a lack or a friction at the non-bank level. It's also outside, and it has to be managed as a community between banks and non-banks. But yeah, it's we are definitely, we agree, I completely agree with you on the risk, but it's not reason enough to exclude non-banks from accessing the payments market, in our view.
Real quick, I think security of finances and identity is equally important as military security for a country. And if it were viewed and treated that way, we would do more of it. I also think that we need to have payment stability as a subset of financial stability. In the COVID recession, cash was the big loser because it was a health shock, and we couldn't exchange cash because of the fear of health. The next one might be a prolonged electronic or a prolonged security attack that is going to take down the electronic stuff. So we need, in my opinion, we need to have a portfolio of payment systems that will work under all predictable circumstances.
And on that note, I guess we will break for lunch. So Scott, Dorothy, thank you very much for your perspectives and your remarks. Really appreciate it.
Eric Belsky. I'm the director of the Division of Consumer and Community Affairs here at the Federal Reserve Board of Governors. And it's a pleasure to be with all of you, both in the room and online. And my job right now is to introduce our next speaker, who is Governor Michelle Bowman. And I want to say a few words in introducing her. She's my boss and oversees the Committee on Consumer and Community Affairs here at the board. She also serves on a number of other committees of the board, including the Committee on Supervision and Regulation, and also the Committee on Payments, Settlements, and Clearance. And she also is the chair of the subcommittee on smaller regional and community banks. So she plays a number of roles here at the board, and she brings to the board a really terrific mix of government banking and bank supervision experience, and now central banking experience. She's been at the board since 2018, so has got a considerable amount of in-the-seat experience conducting the nation's monetary policy. Governors here at the Federal Reserve have a formidable set of responsibilities, and Governor Bowman has a number that I've just recounted. But she has this great background, so I'm going to just say a few words about some of the things she's done. Early in her career, she worked on the Hill, first for Senator Bob Dole, and then in other congressional staff positions. She also served in the executive branch for FEMA, and then as a Deputy Assistant Secretary in Homeland Security. She literally had to worry about people's lives in some of her jobs, which I'm sure is a chastening kind of experience. She also served for a number of years in a public consultancy in London before coming back to the United States to serve as an executive at a bank in Kansas, and then served as the commissioner of banking in Kansas. So very few people have that wide range of experiences. So she's able to see banking issues from a variety of perspectives, and I think you'll be hearing that and seeing that for yourselves today. In my work over the past 6 years with Governor Bowman, I found that she brings important and valuable perspectives to the board, and she really works tirelessly in service of the Federal Reserve's mission. I don't envy her travel schedule, but I do envy her reward miles. It's quite a few miles she puts on, and just in the last month, I think, sort of eclipsed what I might do over the course of 2 years. I have also found her to be a person that values strong analysis and a person who really wants to hear from lots of people. She cares deeply about community development. She cares deeply about financial inclusion. She has an open door and an open ear. As I said, she wants to hear from a very wide range of stakeholders who make community development and financial inclusion happen. She's very interested in the people who are on the ground trying to make this work and to get it done, which is a wonderful thing. She makes sure that not only she hears those perspectives, but she plays a very important role at the board in making sure all the board members hear that perspective, and that it informs their thinking about a whole variety of responsibilities the Fed has for supervision, for regulation, for monetary policy, for payments. So for all those reasons, it's really a pleasure to have her with us today. Please join me in welcoming Governor Bowman.
Well, thank you, Eric. It's so hard to believe that it's been almost 6 years since we've had the fantastic opportunity to work together and with your teams and our teams from across the Federal Reserve System. It is such a privilege to be able to work on the issues and the matters that are so important to our communities across the country, and to help include as many people as we can into our economic conditions and our economy, so that everyone can benefit from an inclusive economy that works for everyone. So I want to start by saying good afternoon and welcome back to this afternoon's second half of today's conference on financial inclusion, practices, and innovations. It's really a pleasure for me to join you again to discuss this important topic. This morning you heard from panelists that provided their perspectives on issues related to supervision and regulation and payment frictions and innovations, both domestically and internationally. The research and perspectives that they discussed can certainly help to broaden our understanding of financial inclusion and all of the associated challenges. Together, Our work to promote initiatives that further this work will enable greater access to financial services. An economy that works for everyone necessarily includes a more inclusive financial system. More expansive inclusion opportunities improve the financial well-being of both consumers and small businesses, thereby contributing to overall economic growth. So today I want to highlight the excellent work that's being done in this area by our Division of Consumer and Community Affairs, or DCCA as we all know you fondly. So I'll touch on some of the ways that the banking system and the private sector can support financial inclusion. So I want to start by talking about promoting an inclusive financial system as a foundational element of DCCA's important work. And before discussing our work at the Fed, I'd like to first take a step back to anchor the financial inclusion within the broader context of fostering an economy that works for everyone. A healthy and robust U.S. economy relies on broad access to financial resources and education. Bringing customers or consumers and small businesses into the financial mainstream helps them more fully engage in the financial system and the economy, and it should help to facilitate a more effective operation of the U.S. economy. Through its responsibility for community affairs, DCCA works to achieve a thorough understanding of current community conditions and best practices by conducting research and convening relevant private sector participants. Today, we'll focus on their important work to enhance financial access. As the chair of the Consumer and Community Affairs Committee, I oversee these efforts together with Eric and his team. As many of you know well, DCCA's financial inclusion work is expansive, and I look forward to highlighting their contributions with you today. First, DCCA informs internal and external stakeholders by leveraging its research and analysis to provide information that can be utilized by stakeholders and external stakeholders to support their work. For example, one of the Fed's most important contributions to the study of financial well-being is the annual SHED, or Survey of Household Economic Decision-Making. We published the 11th annual report in May of this year. So this is a longstanding and extremely valuable resource that is utilized by a number of different resources across the community development landscape. The report addresses topics including financial well-being, savings, retirement, economic fragility, education, and student loans. The Federal Reserve System also conducts the annual Small Business Credit Survey, or the SBCS, which is a survey of over 6,000 firms with fewer than 500 employees that are located throughout the country. This year's survey found that many small businesses were experiencing tight financial conditions and often had to rely on personal financial resources, such as personal funds or a loan from family and friends to support their business operations. Because access to credit is fundamental to the broader financial access and inclusion initiatives, this experience of reliance on personal financial resources shows that credit needs of small businesses may not be being fully met by the financial industry. So another way that DCCA pursues greater financial inclusion is by convening and informing and engaging with stakeholders. For example, the Community Advisory Council, or the CAC, which consists of members of the nonprofit sector and hands-on community development practitioners, meets with the board twice a year to share their experiences and observations and to engage on challenges that are facing consumers and communities that they serve. The CAC focuses on the concerns of low and moderate income people. And at its most recent meeting in May, the CAC focused on a range of economic matters continuing to affect financially vulnerable communities. DCCA also prioritizes the work of mission-driven organizations in its efforts to expand financial inclusion. The Partnership for Progress Program, or PFP, is the Federal Reserve's Minority Depository Institution Outreach Program. created to support the system's mandate to preserve and promote MDIs. DCCA, in collaboration with other areas of the Federal Reserve, engages MDIs and women-owned depository institutions, or WDIs, through national outreach efforts. The PFP also provides technical assistance to help these MDIs and WDIs address unique business model challenges, which helps to enable these institutions to compete more effectively in the marketplace. Third, DCCA ensures that financial institutions under the Fed's jurisdiction comply with laws and regulations that protect consumers and promote community development, including fair lending laws and the prohibition on unfair and deceptive acts and practices. For example, DCCA examines state member banks for compliance with the Equal Credit Opportunity Act, which prohibits discrimination in any aspect of a credit transaction based on gender, race, marital status, age, or any other prohibited basis. The division's work to protect consumers from harm furthers our goal to create an economy that works for everyone. So I'm going to shift to talk a little bit about financial inclusion and the efforts of regulated financial institutions along those lines. So turning to the private sector and how they can engage better to support financial inclusion, the U.S. banking system is well positioned to bring consumers into the financial mainstream by providing innovative solutions to meet the credit needs of their communities. For example, banks help consumers and small businesses by providing financial products and services that are safe, fair, and responsive, including through small dollar lending products. These types of loans can help consumers and small businesses access credit for unexpected expenses. And data from the most recent SHED report found that 10% of adults with family incomes of less than $50,000 a year used payday, pawn, auto title, or tax refund anticipation loans to obtain needed funds. These types of products often carry high or even punitive direct and indirect costs and risks to the consumer. For example, non-repayment of an auto title loan can lead to vehicle repossession, further complicating the consumer's financial situation. When banks offer small dollar loans, they often can do so on terms that are safer and at lower costs than these other types of loans. Some banks that offer small dollar loan products often use automated underwriting based on alternative information that can include consumer permissioned cash flow data. If this data is used appropriately, this approach can reduce bank underwriting costs, potentially making affordably priced loans available to consumers on a more timely basis. If these loans were more available in the banking system, they could serve as an alternative to more costly options from alternative services providers. Small dollar loans targeted to low and moderate income consumers have the potential to provide an accessible and more fairly priced alternative when consumers experience a financial emergency. So as we heard from our panelists earlier today, payments inclusion can look different in domestic and international contexts, but a reliable, safe, and cost-efficient payment system that minimizes unintended frictions is important to consumers around the world. International remittances can serve an important role in enhancing financial inclusion, especially in countries where these funds are a significant source of household financial support. And some research indicates that the ability to receive remittances increases the likelihood of bank account ownership, which furthers economic engagement. However, for those who send remittances abroad, these costs can be substantial. For example, the average cost of sending $200 internationally from the US is nearly 6%. In addition to broader work on cross-border payments, the G20 countries have reaffirmed a commitment to reducing average remittance fees to below 3% by 2030. This could result in a greater proportion of funds actually reaching recipients. Continued improvements to domestic and international payment systems and responsible innovation can also further support our work on financial inclusion. So in conclusion, Greater inclusiveness in the financial system is an ongoing priority at the Federal Reserve. While we have made great progress, there is much more to be done in both the public and the private sectors. And we should be open to considering how new or innovative products and services could also help to promote financial inclusion. We should also be willing to engage with a wide range of stakeholders. Financial access and inclusion are not one size fits all, and they can look very different to each consumer. Therefore, involving consumers and communities in identifying issues and crafting solutions is critical to our success. Advancing financial inclusion will clearly take many hands and a diverse set of stakeholders, including everyone who's participating in our seminar today. So thank you very much for the opportunity to speak with you about financial inclusion. Thank you.
Thanks for your remarks, Governor Bowman. I'd now like to call to the podium to moderate a fireside chat with Governor Bowman, Jen Tescher, who is the CEO of the Financial Health Network. So please join us on the stage. FHN is celebrating its 20th anniversary, and as it aptly describes itself, it's leading a powerful cross-sector movement to create a world where everyone can thrive financially. I like to say I knew Jen when, and when was when FHN was called the Center for Financial Services Innovation. Jen is the founder of that organization and has led that organization for all of its 20 years. And she's just had a remarkable positive impact. She has a unique ability, in my experience, to get people to work together and point them in a common direction to everyone's benefit, and has been doing that, day in and day out for 20 years, and has made a meaningful difference in the country, and is focused on the importance of measurement. What you measure is what you get. And her organization has done a lot there, and has also provided funds to lots of innovators who are working on the leading edge of innovation in this space. So with that, please join me in welcoming Jen.
Thank you so much, Eric. And Governor Bowman, what an honor and a treat to get to have a conversation with you.
It's a pleasure. I really appreciate it.
So I find that for people like you who have passion for financial inclusion and for the outcomes for consumers, that often there is something in their lives that has led them to that passion, either a particular set of values or a personal experience. Where does your passion on this subject come from?
Well, that's a great question, Jen, and I'll tell you, having been the descendant of someone who chartered a bank back in 1882, it's sort of something that has always been a part of my family's experience, is being a part of community banking and contributing to the community in myriads of volunteer ways and in ways to give back. So having the opportunity to actually come back to my hometown of 2,200 people in the middle of Kansas, when I was almost about to turn 40 and begin being a community banker, really helped me be able to immerse myself in recognizing how we could better improve the economic condition of everyone in our community, but not just the people in the community, but the future of the community as well. So beginning with that and being able to help to access or to provide financial services access to people within our community that really struggled in the past was extremely rewarding for me in my role as a community banker. And I've been able to find ways to continue to increase or engage in those ways, and this has been a really wonderful opportunity to work with Eric and his team over the last 6 years to be able to continue that work and passion and to see the passion in others as well.
I wonder if you could give us an example or two of the kinds of sort of aha moments that you had as a leader of that bank in a town of 2,200 people that actually you've reflected on now in this role. I know it's quite a different role, but I think one of the benefits of the experience you've had is actually bringing this is how it's done
perspective to what can often feel like very ivory tower discussion. What are some of the experiences that you reflect on from this seat now?
So some of the most beneficial to me experiences, I think, have been being able to engage on a regular basis with our Community Advisory Council. Throughout COVID, when I came on board back in the end of 2018, things were relatively normal. We were on a path with monetary policy where we were beginning to increase the interest rates. And then all of a sudden, the beginning of 2020 hit. And thank goodness I had the opportunity to see a year's worth of normalcy or apparent normalcy at the Federal Reserve and within our community development communities. But also to get to know the people who serve on our Community Advisory Council and recognize the incredible innovations and communications and insights that they could provide to us at a time where we couldn't talk to people in person. We couldn't have actual conversations in a way that when you're together with people, you have a very different interaction than you do when you're on a Zoom or in a rectangle with many other people. So we increased the number of times that we did these meetings, which originally was only twice a year, but so that we could check in on different types of issues and make sure that our board could hear from people who are engaged in the community to understand some of the unique challenges that we couldn't see, frankly, from here in Washington, but also from not having that ability to interact with people that we might have on a daily basis.
Got it. You mentioned in your remarks a minute ago, you talked about the connection between financial inclusion and a more effective economy. And too often, I don't think we make the argument that's about the good of people, which should be first and foremost. Right. But I do think there's also a connection back to a healthier national and global economy. I wonder if you might say a little bit more about the connection that you see between those two things.
So one area that we've really started to engage in over the last few years is we've become a part of the Central Bank Network for Indigenous Inclusion, which has been a really incredible opportunity to learn from and to share the work that we do across the system, but especially within the board, putting that together for our Central Bank Network for Indigenous Inclusion. So we highlight and I'm going to be proud here. We showcase the great research that we have done and the predictive information that we have that helps to demonstrate how outcomes and access to financial services can provide better outcomes within these communities. So we rely heavily on Minnesota, our Federal Reserve Bank of Minneapolis's Center for Indian Studies, thank you for that. But we also have had the opportunity also to engage with the San Francisco Reserve Bank to better understand challenges facing the Native Hawaiian populations. And later this summer, we'll have the opportunity again to engage with San Francisco to help us better understand the challenges that Native Alaskans face as well with accessing financial services or those kinds of issues and better understanding that more fully from within the United States and our indigenous populations so that we can talk about that more broadly with New Zealand and Australia and Canada as we talk about best practices and ways that we can share what we've learned and how we can improve what we do from learning from others as well.
Can you give an example of some of the challenges that indigenous populations here in the U.S. face as it relates to being able to truly access the financial system?
Yeah, I think that's a great question. And one of the things that's really unique, and I'll just point to tribal lands, is that they have their own laws and legal systems and within those lands that a lot of times U.S. laws can't penetrate. So the things that underpin our banking system, like UCCs and liens, are not available for repossessions, for non-payment, for collateral that might be located on tribal lands.
Like a car, if you can.
Right, like a car or a house loan and those kinds of things, because the ownership is so different than our fee simple absolute sort of thing. people who own, or indigenous people who own houses, as an example, on a reservation, they may have 1/1000th of an interest, but yet they're trying to finance the construction or improvements or whatever it is that they might be trying to do. So there are important things that we have to really understand, and then work together with some of the like Indian-owned MDIs that really are focused on how to address those issues, and then to provide resources that can meet those expectations. And there are similar issues with Native Hawaiian populations and the way that ownership of lands works as well, and financing those.
With the MDIs that you've worked with in Indian country, as an example, how are they sort of dealing with some of these challenges and being able to still follow all applicable U.S. laws and ensure safety and soundness?
Well, I think some of the challenges, and I'll point to Tawny Branch, who's the CEO of one of the Indian-owned MDIs that on the Pine Ridge Reservation, which is a pretty challenging place to exist anyway. But she's a really wonderful example, and Aline Chernoff knows this because she went with me on my travels to visit Tawny at her CDFI there on Pine Ridge. But it is a struggle every day, right, to deal with the issues that come up on the Indian reservations within the tribal populations, to ensure that children are getting access to education and financial education and all of those things. So it's something that they have a unique knowledge of, and it's so beneficial for the population to be able to work with people that speak their language, that understand their cultural differences, so that they feel comfortable. And because it can often be very intimidating to walk into a bank to someone you don't know. But if you have people within your community that you can access, whether it's a credit union, a bank, or CDFI, or whatever that financial entity might be, it's a lot easier to ask a question that you might feel, really intimidated about asking if you're comfortable in the environment.
Let's talk about CDFIs for a moment. You mentioned in your remarks MDIs, WDIs, but you know the Fed does a tremendous amount of work with the CDFI community as well. I wonder if you could talk a little bit about how you engage with them and frankly, why they're so important.
Absolutely. So I think CDFIs, whether they're banks or non-banks, are often better positioned to understand those that they're targeting to assist with financial services, whether that's for small business purposes or whether that's for housing. I think there's a lot of activity in the housing, although maybe not recently, just given the environment. But I think that a lot of them have special purposes and the ability to reach consumers where they may not be able to, other traditional financial institutions may not have access. So it's very important that we have a robust network of CDFIs, whether they're banks or non-banks, that are serving communities in ways that provide sufficient access to financial services.
Yeah.
And frankly, that education is really important, because if we're not educating kids about how important it is to have a bank account, to understand how to pay bills, how to budget, all of those things are so important, and I think we've really lost that track within our education system. I know that my kids are in high school now, and I don't think that they've had any sort of formal classwork or education on those kinds of activities, and I'm not sure how we expect to have productive members of the economy or of society if we're not teaching them how to manage to be financially independent and secure.
So speaking as you, not as the Fed, do you have a perspective on required financial education or training classes in K through 12?
Well, personally, I think it's imperative that we provide some sort of formal engagement within the schooling system. I have a family full of teachers, so I'm sure they'll say, how are we going to squeeze that in? But it's really important that kids have an understanding of how to manage their finances. And it used to be, I'm old, so let me just be honest with you.
We're about
I took
the same
home ec,
age,
right? But did you
you're
take
not
home ec
old.
in school?
I did
mean,
not.
That's where you didn't. Oh, well, that's where they teach you how to manage, the finances of a home.
That must be why
Right?
you're in this job, and I missed that class.
I doubt it. Yeah, well, you're helping other people in different ways, so that's important too.
So how do you teach your own kids about these issues? I know I get that question a lot as well.
Yeah.
I still have one in high school. And there's always this expectation, I think, because we're somehow financial people, that we should have the magic answer. How do you do that?
Well, I think it's important that you bring your children with you to where it is that you're going. And I know that nobody really visits a bank or a bank branch anymore, but I made sure that as we were setting up bank accounts, as my kids got jobs, yes, they have jobs, but they don't get checks anymore, right? So you only have the ability to get paid by ACH or however those drafts are. So we had to set them up with bank accounts, and we went physically into a branch location so that they could understand the process and how important it is that, that we're meeting the expectations of, one, the regulatory requirements, the consumer compliance requirements, and opening, the non-discrimination, and all of those different things. And kids think everything is so easy, but there's a lot that goes back behind that app that they're using. So
that's true.
It's important that they see how it functions and how it works.
So we've talked a lot about special populations, and we've talked about special institutions, but I want to turn for a minute to traditional mainstream banks, because there's a lot they can do to participate in and encourage financial inclusion. And I know that the Fed has been doing a lot to provide a clearer roadmap, both as it relates to using alternative credit data and also around small dollar lending. Let's start first with alternative data. That's been a big theme of today's conference. That's been something that many of us in this room have been working on now for almost 2 decades. And so it's so exciting to see it front and center, and research being done on it, and actual loans being made with that data. Can you tell us a little bit more about the statement that the Fed put out and what you've been doing to try to encourage more use of alternative data?
Absolutely, and I'll tell you, this iteration of the statement, the interagency statement that we published during the COVID times, was really meant to help us better understand and provide access in very unique circumstances where there might not be as much traditional data available to support underwriting for certain types of loans. So it was really important, as we're talking about and thinking about how to qualify people for credit, the types of information and data that could be used, and making sure that consumers were comfortable and permission the use of that data as they're being targeted with marketing materials or those kinds of things, because just because you qualify doesn't necessarily mean, again, this financial education thing, that you should be taking out a loan unless you need to and you have the repayment capabilities. So that was sort of the premise, is that we recognized that there was a need to use additional sources of data for those people who didn't have a credit score or didn't yet have a credit history that could be relied upon by a financial institution in such a formal way. So what came out of those conversations was this alternative data use statement. And I'm not sure how it's being integrated as much into, but I hope that it is, that it's at least an aspect of how banks are thinking about qualifying people for credit.
And, you worked at a bank with 2,200 people in the community, so certainly one needs to follow the Know Your Customer rules, but you also had the benefit of knowing everybody who
That's right.
Walked in the bank.
Yeah, well, that's not always a benefit, especially when you're a teenager.
Right. I'm imagining that could feel more challenging to a money center bank where, yes, we're a human, but like they know us by our account number as opposed to necessarily by name.
Exactly.
What reassurance can you give to banks to make them feel like this is something they can actually do successfully without fear that when they get their next exam that they're going to be challenged for using data outside of a traditional FICO score?
To make banks more comfortable?
Yeah.
Well, I hopefully our statement has gone a long way. But again, I think there's such
a use of data that is within the bounds of the information that's collected by a financial institution, oftentimes it's assumed that, or they feel like it's assumed that it's okay to use whatever sources that they might be able to find useful. And I think the greater implementation of AI is going to further complicate those kinds of activities, because they may sift information whether or not a consumer has provided their consent to have that information used as well. So I think there's great promise with AI, but I think that there are a lot of filters and complications that we need to make sure that we're thinking about as we're allowing that to be used within a really private data kind of context. But it is critically important that where banks are comfortable using that data as a basis for an underwriting for a particular loan, that they're using it as long as its consent is provided by the consumer.
That leads me now into small dollar loans, because I think one of the places where banks are probably making the greatest use of non-FICO data for an underwriting decision is in the small dollar loan category.
Right.
Tell me more about what you're seeing out there and what you're really hoping banks will do there.
So I think there's just a perception, and some of it's reality and some of it is really perception, that if you're offering or providing loans of a certain amount or under about $1,000, I think is generally the threshold thought of as a small dollar loan, that you're going to face extra scrutiny from your examiner for some sort of discriminatory practice, because you may not have a succession of examples of how you've done an analysis of credit, and you may have done a one-off for some reason. So I think there's been a general fear because our compliance examiners have oftentimes been very critical of some of these types of loans, and with good reason, because we need to make sure that they are compliant with our consumer expectations and laws. But there is a need, obviously there's a need, because of the knowledge we have about the amount of funding that is distributed through this non-bank financial system. And I believe, as a former banker and subject to all the rules and requirements that banks are required to comply with, it's a safer environment, and you're more protected as a consumer if you can qualify for a small dollar loan from a financial institution. So my hope is, and our hope was when we were implementing that, again during COVID, because sometimes necessity creates opportunities to move in ways that you might necessarily not have been able to previously, but that there are important needs within communities and consumers for short-term, immediate funding. And banks should be able to provide that within an environment that is safe, sound, and compliant. There are a number of institutions that are offering those kinds of loans, big, medium, and even of a smaller size. So I think that there are programs that can be modeled that are successful and that are viewed favorably by examiners.
Let's talk a little bit about innovation more generally. I know that's a subject you also have passion about and have spoken about publicly.
Yeah.
That's not always something you hear about, particularly from the Federal Reserve.
Right.
And it's a tricky balancing act, right? We want to make sure that we're innovating for the right reason, right? On behalf of the consumer or the small business. We want to make sure that all applicable laws are being followed and that the customer is being protected and their safety and soundness. That's a lot to balance. It's a lot for any institution to balance. How do you talk to banks about that balancing act in a way that also encourages them to try new things?
Well, I think what we need is an environment, a whole of government environment. And I spoke about this recently in a speech about fostering and enabling innovation within the financial system, but specifically within the banking perimeter of the regulatory framework. I think it's important that we encourage and enable banks to continue to innovate. They've been innovating since their inception. we've come a long way from writing checks to ACHs to now using mobile phones to do transactions. There will continue to be innovation in the banking system. It will be better innovation if it's done within the context of working together with the regulators to understand what the implications are and to keep bad things from happening at the design and development phase, instead of while you're experimenting on consumers as guinea pigs and not understanding what those consequences could be. So I think it would behoove us as a regulatory system to better engage and to recognize the importance of continued innovation in a safe and sound way, but we can do that while also having a little bit of oversight over some of those practices and processes with continued discussions and conversations with fintechs. There was a time when the Federal Reserve was doing what we called office hours, where we would invite fintechs in to come and talk to us and invite banks to come in and talk to us too about what it was that they saw as their future for innovation. We stopped doing that sometime at the end of COVID, but I think that those would be wonderful opportunities for us to continue to engage and to reinvigorate discussions about how can we facilitate and foster adoption of safe and sound technology within a banking system.
So it sounds like you think there is a place for responsible fintech in
Absolutely.
addition.
Yep.
It sounds like that the rules around how banks and fintechs and other partners in the community need to work together, that there's probably work to do there also to do more to spell those out. Are there other things that the Fed can do to both encourage those partnerships, but also make sure that they're done in a way that is that is de-risked?
That's a great question, and I hope that we'll have wonderful conversations and fruitful conversations with industry as we re-engage with them about how we can successfully foster safe and sound innovation practices. I think there's come a time recently where we tend to just answer no instead of saying, let's figure out how we can get to yes. And I think that there are a number of ways that we can, one, better understand the technology that is being used, understand what the purpose is, what's the problem that's being solved by it, and three, understand how it would be implemented and how it would touch consumers so that we could better understand if there needs to be new regulation to cover that and to accommodate for that within a safe and sound environment, or if it's something that maybe shouldn't be introduced into the banking system. But until we begin to engage and communicate and have conversations with academics, experts, technologists, banks, or other financial entities, we're not really going to understand what it is that we're looking at.
So I keep thinking back to your family bank. Very small institution, but really knows its community. When you think about the role of technology, what's going to happen to a bank like that?
Well, I'll tell you, when I first joined the bank at the beginning of 2010, we didn't have e-statements, and we certainly didn't have, we had online banking, but we didn't have mobile technology. And so having come from, a banking center in the world in London and moving back to this community, we wanted to bring our bank accounts with us. But when you have the benefits of GSIBs and all of the money that they have with all of the services that they provide, it's a big leap to go backwards from what you're used to respect and appreciate what you can get in a smaller community. So I began to introduce a number of these technologies into our bank. And it's challenging, right? Because it's a very different mindset. Where's the cost? Because it's always about cost benefit. What will this cost us? What are we going to gain? How do we recoup the investment? Because it's very expensive to engage with some of these technologies, even if it is just e-statements. I mean, it's still, per customer, there is a cost. So one thing that it took me years, but I think during COVID they really appreciated it. I began the process of looking into procurement of a mobile banking system, and we partnered with one, maybe naively, but but we did with one called Andiamo at the time, and now it's become a product of Jack Henry.
Yeah.
But it was something that provided a really unique solution to where we saw when people left our community, they were leaving our bank. Because at that point, it was really just second nature that you would bank near wherever it was that you went to school, you lived, or you worked. And so it allowed us to retain our graduating seniors as they went off to college, and then become citizens of the world. They could continue to work at our bank at Farmers and Drovers. So I think it's just those examples where you have to have a little bit of vision and a little bit of faith, but you have to do your homework, right? And you have to understand that your partner also respects the regulatory environment and the importance of consumer compliance and all of those very specific requirements of working within a regulated space.
So as we look ahead to an economy that works for everyone, and a financial system that works for everyone, what's next? What's the next thing on the agenda for the Fed? Where do we all need to lean in to make that a reality?
So I think that's a great question for our DCCA team. And I think one area that we continue to focus very closely on are our CDFIs, our MDIs, and our inclusion efforts. It is absolutely essential that we provide financial services in this country to everyone who needs them or wants them and can qualify for lending or credit or whatever it is that they might desire to have. And through the programs that we have at the Federal Reserve, the programs at Treasury that support CDFIs, it's really important that we engage to ensure that we're providing an environment that allows one, for safe and sound operation, but also for the ability for them to continue to offer the services into the future. So one important conversation will be about the new forms and application process and renewal process that Treasury introduced last December for CDFIs. So we'll be having some conversations in the next week or so with some CDFI banks that are Fed member banks across the country that will help us get a better sense of what that looks like. So.
Which is yet another form of access.
Absolutely.
So we've got to be thinking about inclusion really across everything we do.
Absolutely.
Yeah. Please help me thank Governor Bowman.
Thank you, Jen. Thank you.
All right, thank you so much, Governor Bowman and Jennifer and Eric, for a great set of afternoon remarks to kick us off here. Good afternoon, everybody. I'm David Newville. I'm with the Division of Consumer and Community Affairs, and I will have the pleasure, panelists, please come up. Sorry about that. I have the pleasure of moderating our next panel, which is going to really focus on inclusive and innovative practices related to financial products. And we're going to have a pretty robust discussion, which I hopefully think will tie up a lot of the different interesting questions and themes that have come up in our earlier panels today. We're very excited about. Before we kind of dive in, I just want to do a couple housekeeping notes. One, which is I've been told or asked to let you know that there's going to be fresh coffee outside, although that's not to say you're going to need it because the panel will be stuffy or anything like that, so don't get the wrong impression. But that's outside for folks who need an afternoon cup of coffee like I often do. Today, we're going to basically, we have a very excellent set of panelists here today who offer different perspectives on the consumer community side of financial inclusion. We're going to, each of them is going to bring a unique perspective or at least a starting point. And in lieu of kind of traditional introductions, I'm going to do very brief introductions and kind of give each of them a targeted question to talk about their work, their organization, and ask one sliver of financial inclusion to get us started. Although by no means will we limit their remarks to these questions. We'll start with that, and then we'll dive into some general group questions, and then we definitely want to leave some time for questions from you all too, to kind of dig into these topics. As you heard, there's many rich themes for us to dive into today that we're very excited to dig into. So with that, I think we're going to start with Angela first, who is Vice President, Policy and Research with Financial Health Network, works with Jennifer, who we just heard from, obviously. And the question we'll start with, Angela, is really, and we heard Eric mention this earlier, is really around measurement, right? And defining financial inclusion. Financial health, obviously, Financial Health Network is a pioneer in kind of really defining financial health and what that means. And, you know, when we're talking about financial inclusion, we're obviously talking about positive outcomes for consumers and communities. So would love to hear you, Angela, kind of kick us off by telling us a little bit about your work, and also about, like, how do we better measure these outcomes when it comes to financial health or financial inclusion? And, you know, what are things that either financial institutions can do to better measure these things, and also regulators as well?
Yeah, sure, thanks. I'm super excited to be part of this conversation. I lead our research and policy team at the Financial Health Network and have been there for about 2 years, which is a drop in the bucket of the organization's now 20-year history of participating in these conversations. I'm a researcher at heart, and so I think a lot about data and research and measurement specifically. FHN many years ago developed a definition and an 8-question survey-based measure of financial health. We are right now, this year, in the process of sort of taking a look at that measure to make sure it's still working effectively, it's still measuring this concept of financial health that we want it to measure, and I think importantly, thinking about, is it measuring adequately for everyone in the US, not just sort of mainstream consumers with bank accounts, right? Are we sort of capturing all the nuance there? I think one of the messages in terms of what financial institutions can do is just to start measuring, right? And so, like, one easy step is to either utilize a survey-based measure, and there are several, right? We have our financial health measure, the CFPB has the financial well-being measure, or to utilize transaction or other types of administrative data to start really better understanding the financial health of their consumers and the folks that they're serving. We would say this about employers as well, right? Start with just better understanding who the financial health of the folks who are working with you.
Great, thank you so much for that. Alex, we'll turn to you next with the Pew Charitable Trust Project Director, who's done a ton of work obviously related to credit and thinking about housing issues as well. You obviously, when we're thinking about this morning's topic, kind of kicking it off, thinking about alternative data and small dollar loans specifically, have done a lot of work kind of tracking which banks are, you know, getting involved in this, some of the practices, what forms it's taking, how it's impacting consumers. Would love to kind of hear from you about, you know, the state of these developments and really thinking about, like, where are we in the movie when it comes to these products? You know, obviously it doesn't feel like early stages since you're seeing a lot of financial institutions adopting this, but we don't see a ton of scale necessarily yet, or at least at the potential that's out there. So would love to hear your take on the state of the market, and also thinking about what can be done to encourage more financial institutions to move in this direction.
So at this time in 2018, there were 0 large banks offering small installment loans or lines of credit, 0. And then in the spring of 2018, the OCC had put out guidance enabling, and it really kind of setting up a framework for banks to offer small dollar loans, and US Bank rolled out the first one in September 2018. In May of 2020, due to the work of Governor Bowman and Director Belsky and other folks at the Fed, FDIC, OCC, and NCUA issued joint guidance on small dollar loans. It was clear, it was simple, it was straightforward, it was flexible, and now 6 of the top 8 banks are offering a small dollar loan. Really stunning progress in a short amount of time. The technology involved, this takes a little time. There's build out, compliance. I think we're gonna see more banks join the market before too long. But the fact that 6 of the top 8 banks are now offering a small dollar loan when that wasn't happening at all before is real progress. Bank of America announced in November that they've done 1.1 million of these loans. Wells Fargo announced in February that in their first year with the product, they did 500,000 loans. NCUA publishes data every quarter on their payday alternative loan program. They're part of that guidance. They're seeing growth of 20 to 25% per year. So 10 quarters in a row, they've set a record for small dollar loan volume from federal credit unions. It's real progress. There's still a ways to go, but there are some mid-sized banks that have announced an automated small dollar loan in recent months. And the fact that when consumers are in financial distress, they cite speed, ease, and certainty of approval as what matters most. What makes their long-term financial well-being improve is affordability. Does the payment fit in their budget? And a fair price. So when we had modeled bank small dollar lending, we said, okay, we've got to check every one of those boxes. The 6 large banks that are doing small dollar loans, those loans take a minute or 2 to get into your account after you're approved. It is faster than any payday loan out there, and that's why they're winning. That's why they're having success with customers. Ideas 42 just published some research. Consumers are choosing them for those reasons, because the loans are faster and they're easier to get. Now, to borrow $500 for 3 months from a payday lender is going to cost typically about 15% per pay period. So if you have it after 3 months, $500 would cost $450 in fees. If you borrow $500, you pay $450 in fees on top of the $500. We had modeled that banks could profitably offer these loans if they were charging $60 to $75. So a price point 6 to 8 times lower. The 6 large banks that are doing it are all charging $30 or less. So 15 times lower than average payday pricing. How is this happening? Well, they're not really making a lot of money with these loans. So we're looking at kind of break-even product, sometimes a little bit of a loss leader. And some of them are reporting that it's working and they're making a little money with them. But origination costs had to get to almost 0 for this to happen. Fully automated. It's overnight batch processing like overdraft, where they're pre-approving based on account activity. 4 of the 6 large banks are not pulling a credit report at all. Underwriting exclusively with on-us data based on account activity. Because what happened in your account in the last couple weeks is going to be more predictive than anything that's on your credit report from years ago. Does the customer make reliable deposits here? Do I have evidence this is my primary financial relationship? And if so, customer's an excellent risk to repay the loan. Now, the products are not all the same from those large banks. 3 are open-end, 3 are closed-end. We don't really know what's going to work better in the long term, whether it's open-end or closed-end structure. But banks they're trying something out, and it's more than trying. I mean, we're coming up on 6 years for US Bank with the product, and all 6 of these banks report they're happy with performance. We've seen some adjustments along the way. Bank of America initially had a cooling off period. That was a reasonable guess that maybe that would help customers, kind of take a break and then come back. They saw that customers were going to payday lenders during the cooling off period. So they got rid of the cooling off period, and that was appropriate. That was the right move. And instead, they're limiting customers to 6 per year to kind of ensure that this is not, because that's a closed-end product, and to ensure the customers are sort of using it as intended. But that cooling off period was driving their customers to payday lenders. Huntington Bank initially tried this as a free product if customers agreed to auto pay, and they made an adjustment to price it with a 5% cash advance fee, and that's appropriate so that they can help as many of their customers as possible. Because The product that does the most good in this context is going to be the one that reaches the most customers, because this is the best option out there. Say, right, 15 times less than what customers are paying for a payday loan. And relative to the data point you heard from Governor Bowman, right, about customers using pawn shops and auto title, tax refund payday combined, that's a lot of customers. It's a lot of people who are paying, frankly, very high prices for products that don't have the safeguards that exist in the banking system. And in combination with the changes in overdraft that we saw, especially in 2022, this is good news for LMI households, and this is real progress in a short amount of time.
Thank you, Alex. Janine, I'll turn to you next as the CEO of the Community Development Bankers Association. We've heard a lot about CDFIs. We've heard a lot about CDFIs, obviously, through the course of the day and the important role that they play in financial inclusion. If you could talk a little bit about that and steps that could be taken to support CDFIs in their mission-driven approach to this work.
Okay, sure. Well, first of all, one of the things that I've learned in my many years of working with CDFIs is never assume your audience knows what a CDFI is. So, and I think this audience is probably a little more sophisticated, but, just because for habit, CDFIs are basically specialized financial institutions that focus on providing access to capital and financial services to underserved communities. So CDFIs were in the business of financial inclusion before there was actually even a word for it, before, we were talking about small dollar loans. It's really what they have always done. A CDFI is basically a community development financial institution. It's a designation made by the U.S. Treasury Department. And to receive that designation, at least 60% of all of your lending has to be, by number and dollar amount, has to be to low-income communities, low-income people, or other populations that are somehow underserved. Today, there are about 1,500 nationwide, all different business models, banks, credit unions, loan funds, venture capital funds, but approximately a quarter of them are banks, thrifts, or bank holding companies, and that's sort of the group that we principally work with. To the part of your question that, what can we do to better support, these institutions, I would really say two things. Number one, in terms of, I would say, encouraging the banks that are regulated, by, all of the different bank regulatory agencies to support those institutions, whether it's in the form of loans that can be relent, in terms of partnership opportunities, in terms of investing, and so forth. That's probably the number one. But I think second, I think the bank regulators have, a potentially very powerful role in supporting CDFIs that are banks, thrifts, or holding companies, because of their role as, the regulatory agencies. I mean, these institutions are doing the hardest work in financial services because they are serving those markets that others find really difficult to serve. That's why, their work is very unique. I think probably the first thing is in terms of the regulatory agencies. I'm going to take advantage of the fact that we have people from all the regulatory agencies here, which I'm glad to see. Is understanding the business model of the CDFI. These are niche institutions. Most are small, and as small institutions, they are very close to their community, and they do understand the customers and what their markets look like. But because they are a small niche within the much larger banking ecosystem, they're often very, not very well understood, particularly when it comes to examiners. So. What distinguishes them from others is they meet the customers where they are. So, we've talked a lot over the last several panels about kind of automated systems and making things, instantaneous and so forth. While I think, yes, that is important, I think there also needs to make sure that we also have the ability for those that don't fit the standard, that don't fit the box, that don't fit the credit box, that there are models that can accommodate that as well. I think, one of the things I think that would be helpful to support these institutions is if each of the regulatory agencies had a specialized team on the examination side that understood this group of institutions and would be the team that would do their examinations. I think very often, because they are not well understood, an exam team will come in, and depending upon what part of the country you're in, because there are, there are some parts of the country have virtually no CDFIs, while others, there's more geographic concentration of them. An examination team may come in and they've never even seen one of these before. And a lot of times, because they're small institutions, you get younger examiners that are still, sort of learning the craft, that, sort of these institutions are doing things that they haven't seen before, which makes it more likely that, they may get, they may get dings for doing something differently, for doing something outside of the box. So if there were some specialized teams, to focus on doing the examinations, I think that's a way that you could support these institutions, because once those examiners understand how the business model works, they get comfortable with how people are doing things.
That makes a lot of sense. I guess one follow-up for you too. I mean, thinking about where CDFIs are today, after kind of explosive growth in CDFIs, thinking about during the pandemic, all the unprecedented funding and so forth. Now that we're kind of coming out of that, and thinking about, obviously, with, as Governor Bowman mentioned, there's a new certification process for CDFIs, the biggest change, the first time it's been changed since CDFIs were introduced. Are there other challenges to think about for CDFIs particular to this moment, in addition to kind of better understanding the work of these institutions?
Do you mean changes in terms of the certification rule itself, or just in the greater environment?
Either or both.
All right.
Yeah.
I think in terms of the new certification rule, honestly, I think we're going to have to work with the CDFI fund, as they try to implement it, because it is the most significant set of changes that they have done for a while. There are some concerns, sort of in their desire. One of the things that incented this big change is concerns that there were institutions that were maybe, getting certified or had gotten certified, and maybe later the fund found out that they were offering products that might be less than, consumer-oriented, consumer-friendly, and so feeling the need that we had to tighten up on what some of the requirements, sort of may be. And I think the industry generally has supported and applauded those efforts. But you know how the pendulum can swing in policymaking. Sort of there is still some concern that maybe it's swinging a little bit too far, and maybe people are losing their flexibility. And what makes CDFIs really unique is that they meet the customer where they are and take the product, and to tailor the product around the customer versus having the product and making sure the customer comes to them. So I think we're going to have to work with the CDFI fund, sort of through this. In terms of the broader environment, you're right. We have come out of a period where there's been more capital that has gone into the industry than ever before. I think everybody's still absorbing, the capital and what that means in terms of operational changes at the same time where affordable deposits are very hard to come by. So, I think there's still going to be growth, I think, in the industry. I'm an optimist, so I believe we will get through all these problems, sort of with the CDFI fund, but probably the biggest challenges right now are really, how to manage growth, which is, something that they haven't had much of an opportunity to do. So.
Thank you for that. And last but not least, Jose, CEO and founder of Mission Asset Fund, which has done revolutionary and innovative work in thinking about access to financial services and products, particularly for the immigrant community. Picking up on a theme that Janine kind of pulled out, not understanding certain products serving specific communities. I think we all know financial inclusion is not a one-size-fits-all prospect. There are different consumer needs, there are different consumer preferences that are out there. Better understanding how to apply those and how regulators can both understand those when they see those and correctly calibrate risk when it may be different and something that they're not familiar with. And also thinking about how we best, as financial institutions, best tailor and adapt different products and services that can really meet consumer needs. As we see this turn that Alex referenced about, banks finally kind of catching on to some of the non-bank practices of really thinking about what are the drivers behind consumer preferences when it comes to small dollar loans specifically. Would love to hear your take about that. How do we promote a more nuanced, a truly inclusive financial inclusion practices when it comes to both financial institutions and regulators?
Big questions. So, before I kind of get into that, I definitely want to acknowledge, how meaningful this conference is. I was kind of sitting talking to Jen about this. I was like, oh my God, I can't believe that in the past 20 years of doing this work, that this is the first inaugural conference on financial inclusion. So congratulations. I mean, for joining, into this conversation head on. I mean, I think that's actually, something that we need to sort of, want to applaud you and thank you for doing that. And also thank you for having me on the panel. So as the founder of the Mission Asset Fund, we're a nonprofit organization, now CDFI, a loan fund, that we've been working in the Mission District. We started in the Mission District about 17 years ago, and helping low-income immigrants to build and improve their financial lives. When we started that work, the question was like, well, how are you going to actually do that? When in fact, the people that we were trying to help, didn't have any access to the most basic of financial products like checking accounts or credit scores or credit reports. And so I kind of, I turned to my board. I'm like, I don't know how we're going to do this because I believe in the mission. I believe in what we're trying to do here. But without having a clear access to those tools, I mean, people can get jobs. They can't get in, in many cases, they can't even get an apartment without a credit report. I mean, some states even still require a credit report to get a job, right? So how do you expect for somebody to build their financial lives when in fact, they didn't have any access? So when even before we started our programming, it really dealt with that question, head on. And in fact, again, you guys are taking me back, okay? So please allow me the memory lane here. In fact, we actually did a survey of financial products and services that were being provided in the Mission District in San Francisco, and I had some staff walk along Mission Street, in Valencia and other streets, and I gave them a direction: go to every street, or every establishment that dealt with money. If you had money as your product, go in and ask for a $1,000 loan, just to see what would happen, right? So they walked into banks, they walked in credit unions, they walked into pay-to-lenders, they walked into even, pawn shops, and then we tallied them all up, and we found out there were more financial institutions in the Mission District than there were Mexican restaurants. And if any of you guys know the Mission District, that's like a big statement to be said. But what we found out was that, the people couldn't get a $1,000 loan. With banks, credit unions, and others, they were like, well, here's a credit card, here's a credit card, here's a credit card, because that was like the only product that they had available to them to actually provide, access to that loan. Now, of course, you can get a loan from payday lenders or others, but that was a very high cost. So we wanted to document, basically there were any products out there, right? And so that was back in a long time ago, okay? And so since then, and I'm very happy to, have heard reference to the CFPB's, I think, important document, which is the Credit Invisibles, that kind of came out, was it 2016, 14? I don't know, a long time ago as well. Because I was part of those conversations where I say, hey, credit building is an important strategy of helping people build their financial lives. So we need to, pay attention to that. And so that was one of the first federal efforts, actually, where we said, like, well, let's look into that, figure out what exactly that is. And thankfully, with the direct, under the leadership of Richard Cordray, they actually, created that document that, is essentially kind of, documented and saw that as a strategy of moving forward. So I'm happy, that that's still being referenced. And as well as all the other institutions that are creating small dollar loans, like U.S. Bank, as part of their advisory board, that, cheered them on to make sure that it actually happened when they did. And so I think we need a lot of that so that we can kind of show ourselves that in order to actually deal with this issue of financial inclusion, it's just that we need to just do it, right? We need to understand and kind of question our own assumptions and then actually try out different products. One of the things that I'm that I do adhere to, though, is a concept of financial inclusion. That sometimes, and I think it was referenced earlier to that, but I want to underscore this idea too, is that I think it's a mistake if we narrow it down to the concept that that financial inclusion equals a transactional account. I think that's a mistake, and I think it was referenced already, and I want to say me too on that regard, because financial inclusion is more than that. It's actually a bigger concept than that. So it's not just about having an account that might be there may be no money in it, no transactions happen through it, and I think we've seen that in international studies. I think Kenya was mentioned already, and they've also seen this, like they give people an account but nothing happens, or you deposit $100, but $100 goes out the door the next minute, right? So that doesn't really solve for issue of financial inclusion. In my mind, actually, it's broader in a sense that you have to have people. People have to have access, but people, you also have to have products that are available and built in the context of their lives, and they also have to be affordable. So you have to sort of solve for those three problems at the same time in order to really realize the potential of financial inclusion. So access, availability of a product that is practical in the context of their lives, and it has to be affordable, meaning that they can actually, transact. So it's not to say that it's free, but it's to say like there has to be, meaningful, from an affordability standpoint, to people. Because here's what I've learned, and I want to just end with this to your question. That to help people build their financial security, particularly for the people that we work with, which are low-income immigrants, what I've learned is that it really is really dependent on their, what I've learned to say is like their proximity to citizenship and their ability for self-enterprise. That proximity to citizenship is really interesting, right? Because it's not just about legal status, but it's about a sense of belonging, a sense of like, oh, I see you. I see that you have special needs, you have different needs, or you're in a different point in your financial journey. And so for a financial institution to basically recognize their belongingness is really key. So proximity to citizenship is that the people that are closest to that notion of belonging in legal status or sense of this is who I am as a consumer, they're more than likely are going to be financially secure. People that are further away from that, they're the ones that are struggling the most. People that are, that have ITIN numbers or have no numbers to speak of, or people that are, they just push to the margins. So those are the folks that are more financially, insecure. And the idea of self-enterprise is really important as well, because folks, they want to be a part of something. And so sometimes they have to sort of rely on themselves, their family, the community to actually make that happen. So as long as people have a sense like, yes, I can start a business, or I can, even push a car to sell, sell tacos or sell whatever, then that ability to self-enterprise allows for their self-confidence to increase and actually see, progress in that regard. And that's really key in terms of thinking about, well, financial inclusion is not just a product solution, but it's about how do you create products, an array of products that are actually tailored in the context of people's lives. And so as a CDFI, I think I've definitely have had that experience of having that unique space to innovate, to sort of, show and demonstrate, create something that works, and then speak about that. I know, however, that other institutions don't have that because they're a little bit more relegated in different rules, or different sort of parameters. But I think we need to sort of allow for more innovation so that we can actually create different products that are relevant to different communities at different points in time. I can't see you, David, but
Thank you, Jose. No, that was great. A great overview there, and a great kind of expansion of how we think about financial inclusion. I'd love to open it up to the full group now. It's a general question for everyone to jump in, to kind of pick up on that theme and hear more about like what are, obviously we've heard a lot about kind of these automated small dollar loans, but what are other exciting, innovative, emerging practices that we think can really move in this direction that are either being offered or beginning to be offered right now that you all are kind of seeing out there, whether it's in the CDFI space or, larger banks or thinking about, or in the non-bank space that might be coming in eventually over to, to the bank space as well, or in partnership. It could be small. If there are other models too, would love to hear about it, because obviously there's a huge need around small dollar lending.
I'll just say, I think that there's a lot of nuance to this question, and it's been mentioned just today that many available products and services on the market right now are sort of great until they're not, right? And so I think, there's a part of this conversation that's about what do we need to develop and what are the products and services we need to identify. And I couldn't agree with Jose more in that we need to really think about communities and the individuals who will be using these products and services. But I also feel like there's an opportunity to think through utilization of existing products and services in a meaningful way. And I would put, earned wage access, BNPL in those categories, where certainly there are opportunities for a consumer to use those in ways that's supportive of financial health. And we also know, and there's plenty of research and literature to suggest that sometimes BNPL, earned wage access, these types of products sort of end up being having a negative impact on overall consumer financial health. So I think that there's sort of that nuance there.
Yeah, I would probably add, if you want to be outside of, the small dollar loan space, although there is a lot of innovation going on within the small dollar loan space. One example that I can think of is there are a number of CDFI banks that basically host VITA sites, for helping low-income people prepare their tax returns, for the year. And lots of times, low or moderate income families don't know, that they're entitled, to certain types of tax credits or benefits, earned income child tax credit, and others. And so Southern Bank Corporation, they are based in Arkansas, kind of sort of Arkansas, Mississippi Delta. And what they do is they've been doing for years hosting VITA. They have thousands of, sort of both bank employees as well as volunteers that come in terms of help with tax preparation. And, what they do is, not only help them with their taxes, but they set up a bank account. So when they get the tax returns, that it goes to the bank account. And so they help some of those that have not previously been able to, haven't had a bank account or, so forth, be able to at least get a toehold into the system. And, sort of the nationwide in terms of the earned income housing tax credit, $2,500 is what the average sort of refund that a family would get. And so that's significant in the context of a low-income family. So that's an idea where they sort of provide a service that's value added, to the customer and get them into the financial system, into the bank. And eventually they may become, sort of more robust types of customers of the bank, but at least gets them into the system.
And innovation, I think, it can mean adding a product, it can mean improving a product, or it can mean getting rid of a product. And in 2022, I mentioned before, there was just a stunning wave of announcements from banks announcing they were eliminating non-sufficient funds fees, overdraft transfer fees, extended overdraft fees, and for some of them, overdraft fees altogether. I did not anticipate something like that happening, but to see banks drop their overdraft fees from $35 to $10, or $35 to $15, or to limit overdrafts to 1 per day, or to create a 24-hour grace period. And I think part of what happened there was the rise of the neobanks, and that as neobanks emerged, and some customers voted with their feet and went to banks, because none of the neobanks had overdraft fees. But pretty much all of the big banks at that point had overdraft fees. And so we saw some customers vote with their feet and go to neobanks. I think it was really hard for banks that had gotten used to the overdraft revenue and the fact that there was that enormous decline in overdraft revenue during COVID, because there were fewer consequences for non-payment of bills, there was the student loan freeze, there were some supports, utilities weren't being disconnected. And so, overdraft revenue plummeted in the second half of 2020 and in 2021. And so then the year-over-year comps weren't bad anymore if banks made a change to overdraft because they didn't have that much overdraft revenue the year before and the comps got a lot better. And so that, some appropriate scrutiny from regulators, and then the competition from the neobanks was really a combination of innovation outside the banking system, some scrutiny in the banking system, and an unusual set of circumstances that led to something happening which I didn't foresee coming, which was that enormous drop in overdraft revenue because of those reforms. But also these things don't happen on their own. NSFs, non-sufficient funds fees, shouldn't have existed. That was a fee you were charged for a bank not making a payment on your behalf. And there were overdraft fees, a fee you were charged if a bank did make a payment on your behalf. They shouldn't have existed at all at this point in time when customers weren't using paper checks, but they still did. And then they went away really quickly, and now almost no large banks charge NSFs. I think that is a form of innovation, in part driven by actual neobank innovation, but regulatory scrutiny in this special set of circumstances, and that's real progress, and that's saving mostly low and moderate income households around $5 billion a year. That's real money.
Wanted to add to the question of innovation. One of the things for MAF, when we understood that we needed to actually address the questions of giving people access to checking accounts and credit scores, we actually innovated based on what people were already doing with their money. So it wasn't something that we went up in some mountain, cooked up something or another, and came back down and gave them some solutions. It was more like, oh, this is how you guys are managing your resources. Because I think one of the critical thing that we did off the bat was we rejected the notion that one of the problems is that people were just illiterate or dumb, or they weren't doing enough with their money, or they weren't managing the money well enough. When we actually started to understand what people were doing with the money, we were like in awe. I was in awe that people were actually transferring money or managing budgets across denominations, across countries, across families. I mean, it just I kind of went in with that sense of awe to understand how they actually manage their money. And one of the things that we found was that that people are actually very active in this group activities called tandas, cundinas, susus. It's a very informal way of lending and borrowing money with one another. And in fact, they've been doing this for millennia, not just now, but they've been doing this across the world, right? And so we're like, oh, but it's informal. So something like nobody else is, taking into account. And so we then found a way, we were innovative in the way we looked at it and the way I found a way to help them formalize it by getting people to sign promissory notes saying that I, Jose, will join a group, and then I promise to pay $100 for the next 10 months against a $1,000 loan. And then imagine a group of 10 people, they all do that, and and one of those persons gets $1,000 every month until everybody gets a chance at getting $1,000. So by us, innovating, not necessarily in the product, but it's more like formalizing what they were doing, we were able to create what we call lending circles. So these lending circles, by formalizing, we were able to then report to the credit bureaus, and by reporting to credit bureaus, we're helping people build and improve their credit score. And by that, I mean their FICO score, right? Not the alternative scores, not anything else like that's something that other lenders wouldn't take into account, but their FICO score, because that's the one that really matters in our industry. And so that was a huge innovation that really was born again from us acknowledging what people were already doing with the money, by figuring out a way to actually then formalizing it so that the rest of the system can understand and appreciate the awe and how wonderful that we're doing this, right? So it wasn't that we were changing them. We weren't telling them to stop doing that, and we don't even charge them zero interest, zero fee loans. And knowing that by improving credit scores, we're opening up the door to the world of possibilities for them in the financial marketplace. So innovation, I think I want to kind of say that because it doesn't have to happen. And there's what is a completely new and different, or what is the latest tech, or what's the latest button that we can press. But sometimes it's more like, oh, this is how they do it. How do people save? How do people lend? I mean, even understanding their relationship with money. You can actually, build innovative products and services by that, from that. And so I think it makes it more simpler. And then we've been using technology to just help us scale that, across the country. And so I think technology has always been a front and center to everything that we're doing. But technology, I guess innovation, again, is not something that has to be completely and absolutely brand new, but it can be just as a new way of looking at how people were thinking or managing their money to begin with.
With respect to innovation, if what we're trying to do is promote innovation, I think one of the really important things that I think the agencies could do is to play a more proactive role in terms of publicly promoting innovations that it sees, sort of in terms of banks or other lenders that are out there in the marketplace. Because I think, sort of with regulated institutions, if they know that they're, the Fed is highlighting this or highlighting that, that's going to be a safer, and when I say safe, I mean, sort of safety from your examiner, sort of type of a product to pursue. Couple good examples, one that, Alex just mentioned, but even before that, in 2008, when the FDIC first put out its small dollar loan pilot program, CDFI banks were doing it, sort of, and other small banks were doing it, but it was sort of like, I don't want to say under the table, but very quiet, that they were doing it. But, sort of once the FDIC put out a model of what a good product or a product that they thought was a good idea, then suddenly you had banks across the country, small banks across the country that started doing small dollar loans because they're like, okay, they may have seen the demand within their own markets or seen the opportunity for doing it, but not knowing a product is going to be okay with the examiners, not everybody was eager to jump in. So having the FDIC hold that up, now you'll find banks all over the country. Probably every single CDFI bank has got some version of a small dollar loan product, which usually started with, sort of that pilot, and then people would iterate off of that. Now, Alex's example in 2018, when, sort of when the OCC put out its sort of statement, sort of about small dollar loans with the bigger banks. Once the agency did that, then the bigger banks are like, okay, I'm going to get into this. So I do think that, sort of from its bully pulpit, not that the agencies would ever call it that, sort of, but from, that national platform that you sit at, you can promote innovation by highlighting some of the innovators out there.
Thank you all. When thinking about, these practices, obviously, whenever you think about innovations, you think about, obviously technology plays a big role in the role of fintech and that. And obviously, as we heard here, sometimes it's about taking things off the table. Sometimes it's about practices that have been around a long time, but are not really fully recognized by the mainstream financial system, or technology can enable them in new ways when they are informal. How do you all think about the role of technology in that sense when it comes to this? And obviously, it can be a double-edged sword in a lot of ways, but what are the right ways for financial institutions and regulators to think about emerging technologies from that perspective when you're thinking about, okay, how do you weigh whether to recognize the trade-offs and the risks and the benefits involved in new technology and how it might be adopted, whether in the non-bank sector at first and then in the mainstream the mainstream financial sector later? What's the best way to evaluate that in a way that can really adapt the promising practices in safe ways and doing them, as Angela pointed out, sometimes it's in the way that you kind of roll them out and the safeguards that you have around them, but making sure that you're not holding back when there is potential for something like that.
I can add a couple of thoughts here. Coming from San Francisco, I have to use the word in disruption at least 3 times in a sentence, so that I can keep my, credentials. Sometimes I think about the opposite of that question. It's like, well, try to do something without technology. You can't. I mean, why would you want to, right? So it's not technology, no technology, but it's more like how do you use technology, particularly to help those that are at the edges, people that are at the margins of society, right? And so thank God that technology is there. That now is a lot more cost effective for an organization like MAF, small CDFI, to actually do that. So we actually created our own lending platform to actually, be able to sort of scale that program, beyond San Francisco and doing it across the country using technology. One of the insights that I had, in doing all of this work is that for the clients that we serve, that they're really typically the secondary users of financial products and services that are created for richer, wider communities. And I think, ever since I kind of came to that realization, I was like, well, why is that? Why is it that banks always sort of focus on, wealthier communities rather than people that are in the margins? And I think there's some regulatory, essence to it. And I think I would love to just kind of share that notion with you. Because I think, most of banks, not just banks, but I think our industry, we're sort of trained to think about serving the median. I mean, you all know the nice distribution charts, right? So we all are trained to think about, let's look at the median, the average, this type of client that lives right in the middle of everything, right? And so I think a lot of our services, a lot of our products, a lot of our rules really are set to serve that market, which I think it makes a lot of sense because they're all there, right? But sometimes we forget, the people that are in the tail ends of that distribution, right? The people that are, and not necessarily in the median, but people that are in the tail ends. And I think because of that, our system is sort of geared towards serving that type of client versus the people that are in the tail ends. And now with technology, we actually, can make it a lot more efficient and affordable to serve people that are in the margin. So I think it's a good thing. It's just a question of what is the intent? What is the purpose? Why are you doing that? And then what can we learn from that so that we can serve the middle better, honestly. So it's not an either or, so that way we can strengthen those rules, ideas, and concepts, so that way that the system as a whole could be strengthened. So it's not an either or. So again, technology is something that we can use to be disruptive. So there, I kept my credentials. Thank you.
Well, I think basically, technology is neither good or bad. It's really about how the people behind the technology are using it. I think that in terms of, there are some, sort of innovations such as, the interesting work around alternative data and how that could be used, to streamline the underwriting process. That is interesting, but, and it could potentially be helpful to underserved groups. But my concern about automated underwriting systems is that, they can't be expected to work for everyone. They really are only going to work for those you indicated that are kind of in the middle. And, but if you don't fit the standard credit profile, it might not work so well for you. The same for AI, it's the same sort of conundrum. AI could be really helpful for a small bank in terms of making its back office operations more efficient. That's a really helpful use of AI so that you don't have to have staff doing very manual types of things. But I don't know how, at least my gut at this point from what we have seen is that it probably would be inappropriate as an underwriting tool unless the AI gets a lot smarter than it is right now, because otherwise it tends to just replicate existing biases. So.
Yeah, I agree that I don't know if the question is so much, how should we use technology and AI? It should be the question of how we use AI and technology rather than whether we use AI and technology. At FHN, one of the projects we have ongoing right now is called Financial Health Frontiers, where we've sort of taken a look back over the past 20 years and started to identify some of the trends that we think are going to be impactful as we move forward into the next 20 years of financial health. And certainly technology and the utilization of AI is one of those topics. And I think as we've thought about these sorts of issues, it's been really thinking about how we use technology to support consumers, and frankly, what are some of the barriers to the use of technology and AI that consumers might face, and specifically consumers who are most at risk. So there's some research that we've put out in collaboration with the FINRA Foundation that suggests, for example, financial information coming from an AI is less trusted. And so I think certainly there are these issues around trust that we've got to think about and address as we continue to move forward in thinking about how to utilize technology, and specifically AI.
I know that there's real concern about bias in a couple areas. Think of during about 4 years ago, the analysis of or maybe 3 years ago, the analysis of the Paycheck Protection Program loans, that it looks like in some of that lending, there was some evidence of discrimination. And the programs that used the most automation and used the most technology showed the least evidence of discrimination and the most equitable access to that credit. Thinking about seeing evidence of appraisal bias in home appraisals, which are an important element of the mortgage lending process, that there's some real evidence of appraisal bias out there. And I think that automated valuation models could be really helpful, both in reducing bias, but also in reducing costs, because home appraisals are a major component of closing costs in getting a mortgage, especially in rural areas where home values are lower, so closing costs are going to be lower, but travel times are going to be longer. And there are fewer appraisers. It means it can be a real cost to have that home appraisal, especially for a small mortgage in a rural area, and technology to enable automated valuation models. Not that, then there should be a chance for an appeal if something comes back wrong. And that you could do it manually too, but I think enabling more automation can be useful both in reducing bias and reducing costs in those contexts. And with respect to bank small dollar loans, candidly, we just never would have gotten there if this weren't automated. This is only working because people are using online banking and mobile banking. There was just no way to get loans out there at volume with low prices if staff are processing every loan application, if there's a review of a credit report. This had to be automated. And it's good for consumers too, because it means it's the fastest thing out there, which is why they're choosing it. But it also reduces costs so dramatically for banks, even as they're often white labeling the process through a third-party technology provider. Only maybe 5 or so institutions are actually building these loans out in-house and doing the whole thing themselves. Most of them are using a technology provider that is layered under the whole process and is enabling the application processing, the underwriting, is setting up the loan for usually electronic repayment, and that's crucial. Even if you were building out the technology in-house and are technologically savvy, unless you're a very large institution, the economics of it don't work. So that's both true where the technology was essential from the consumer side, but also from the provider side. And without both, this wouldn't have happened.
Thank you all. I will ask one more question to our panel, then we'll open it up to you all to get your questions as well. Last question I'll ask for now is, I definitely, we're thinking about financial inclusion. This has come up already in our panel and in previous panels with some of Scott's comments in the payments panel, really thinking about the past 30 years and how by metrics, at least in the original, was very binary. You either have a bank account or you don't have a bank account. And people who don't have a bank account obviously are not financially educated in thinking about that piece. But as we've seen the standard metrics of financial inclusion increase, we haven't really seen the other metrics around income, around wealth inequality, and those other increase. And thinking about, if we're really thinking about financial inclusion from improving the financial health or the financial well-being of consumers and community, what should we be measuring for if we're moving away from those traditional metrics? How should we be thinking about it? But also fully recognizing that financial inclusion as we think about it is not going to is not encompassing all those pieces when it comes to those larger trends. But are we thinking about them correctly? And if not, how should we be calibrating for them going forward? It's because we've had 20 years of learnings, of progress, but clearly it feels like we're at a pivot point in the evolution of financial inclusion, or whatever we want to call it going forward. So would love everyone's thoughts on that.
Okay, I guess what I'm going to say is I think that, when you talk about progress, part of it is, okay, we're solving for the access problem to some degree, but you're not seeing improvements in terms of economic outcomes for some of the people that are now have access perhaps that didn't. And, honestly, I think that a lot of it has to do with growing income inequality, which I think is probably the greatest threat to financial inclusion, because if you have this increasing gap, you're going to have more haves and have-nots, which I think is what is contributing, sort of in large part to not seeing any economic, sort of progress. I do think that there are other things that I think the regulators could do to at least address some of those problems, because some of it has to do with trying to address, kind of systemic inequities that are there, because it's the same groups of people that are still stuck, sort of in terms of the bottom. A couple of recommendations that I think should be part of the conversation, certainly looking at special purpose credit programs, can allow, a degree of innovation in terms of trying to target resources, trying to design programs, services, products for specific underserved groups. Another thing, and this is, sort of when we were doing our panel prep, call, I asked David, sir, can we put some sacred cows on the table, sort of here? And, one of the things that, some of our banks that are really committed to serving the underserved market segments have found is that often there are barriers intended to, sort of, let's say ECOA is sort of the prime one. It's a very important law. It's intended to, sort of address problems of overt discrimination, and I think it has been effective, but now we have been many decades, since the original inception, and we can't push those indicators much further. The same group of people are having a hard time accessing home ownership, increasing income, and so on and so forth. And, sort of, I think there are some things in terms of how ECOA is implemented, not the law is good, but how it gets implemented that I think may make it more difficult for us to make progress. And, specifically when it has to do with around data is actually one of the things. Because the statute says you can't use race, ethnicity, gender, and other demographic characteristics in the process of making a credit decision. But the way that it has, over time, implementation has evolved is you can't collect data. And if you can't collect data, you can't know if you're trying to do a good job, if you're trying to, serve underserved communities, minority communities, ethnic groups, you can't know if you're doing a good job if you don't have, data to help you with that. So some of the, in the examination process, none of that kind of data can be collected. I think that's a problem, because it means you can't target your resources, sort of to places that need it. Likewise, sort of the way that, some of the examination requirements work when it comes to doing marketing. Sort of we don't want to trigger a UDAP problem, so therefore we don't allow, sort of any, except under a special purpose credit program, sort of any proactive marketing to underserved groups. And so I think having more flexibility around that, if you are actually trying to get to a group of people that don't have access, I think there needs to be greater flexibility in how ECOA gets implemented so that we can be proactive in getting to some of those groups where there are systemic barriers.
I totally agree with that notion. I think kind of goes to the idea that you have to focus on the tail ends. And I think, regulatory speaking, we haven't been allowed to do that as much. I think the notion of financial inclusion, I think I would broaden it to be more inclusive of not just access, but also, creating affordable products and even products that are in the context of people's lives. I mean, just imagine that, there's been several reports, and I think you guys came up with a report that found that, for low-income individuals, that they spend like up to, 10% of their income on financial products and services. Imagine anyone spending 10% of your income, and more money on that than you spend on groceries. Is that correct? Back me up here, because it's true. But that's just unconscionable. For us to sort of allow for that to happen, right? So I think, in thinking about inclusion, that can include the notion of affordability and include the notion of building, products in the context of the people's lives, requires flexibility. So it can't be a one product for everybody, because then that's not for poor people. Then we're not talking about their needs anymore. We're talking about just people that are in the median, and they need to be, they need services, right? But they can't get all the services, right? So I think we have to have a much more broader, expansive view of what inclusion truly can be in order for us to innovate, experiment, and use technology, and then allow for failure to happen on the edges. Allow for that, right? I mean, some products are not going to work, and that's fine if it happens there. But as long as we learn something about how to include people and really truly, uplift their or allow for their potential to be realized. The last thing I'll say too is that in thinking about particularly immigrants, the issue of identity is critical. I mean, there's a lot of banks, a lot of other institutions that are not allowing, for products to be accessible for people that have ITIN numbers. I mean, including a lot of the programs that we just talked about today. And so that's a huge issue, because now you're, saying like a whole, millions of people that just because they have a particular type of ID number, they're not, they don't have access to that, to those services. So I think we need to allow for more, broader access, or allow for other elements to be, used as IDs. I think they talked about it in the international sense, that we need some form of a financial ID that could be truly universal, that maybe it's not Social Security numbers or ITINs, it could be something else. I don't know what that is, but I think we as a system or as a society need to come up with some other way of ensuring that people are included. So there's a lot of other bigger questions I think we need to tackle with, but one, I think we need to, not be so narrow in our definition of financial inclusion, have a more expansive definition so that we can see and really realize all the opportunities to make something happen in the world.
Yeah, that is our spend report, which I will preview and say our report looking at calendar year 2023 should be out in the next month or two. So if you aren't on our mailing list, please join to get that. But what that report has consistently shown, and I think we've done it for about 5 years now, is that individuals with lower incomes, often these are also individuals who sort of score, according to our financial health score, in our financially vulnerable category, are paying really a disproportionate percentage of their income in fines, fees, interest for financial products and services. And spoiler alert, that's not changing when we release our report in the next couple months. That is going to be consistent. And so despite, I think, some of the great innovations we've seen that do seem to be supportive of financial health, the elimination of overdraft and NSF fees, which we pick up in our data, we continue to see this real disparity in who is paying for financial services and who isn't. And I think the key, and I have to agree with sort of these panelists as well as the panelists earlier, putting on my academic hat, I'm adjunct at Northwestern, really the research that's needed is the hard research to do. It's the research on specific communities, specific populations, and often these are folks who aren't necessarily on the internet panels. So we released some work on individuals with disabilities and the financial health of disability of individuals in that community. 15% are unbanked in that community. And so I think it's really getting nuanced now and thinking about how we use technology, how we use innovation to tailor products and services that address the financial health of specific communities and not, to your point, sort of the cutout consumer.
So I feel like I've been full of good news today. I've been saying all these nice things. Bank small dollar loans going well, right? Overdraft is going well. So mortgages, not going so well. And I think that's the area that I'm most concerned about on the bank front. As recently as 2013, banks originated 53% of mortgages in the US. 2022, banks originated 29% of mortgages in the US. That is just an enormous drop-off in such a short period of time. And yeah, there's been growth from specialty mortgage lenders taking advantage of technology and doing a lot of refis especially. But the racial wealth gap is yawning, as David alluded to. The racial homeownership gap is as bad as it was in 1968 when the Fair Housing Act was passed. So to make a dent there, that's going to mean thinking about mortgage lending. And mortgage lending standards were tightened at the start of the Great Recession, and they were really never relaxed again. So there's a whole category of people with pretty normal credit scores who are not qualifying for mortgages. The biggest drop-off in mortgages has been for mortgages under $150,000. Now, that's not going to buy you much in DC. It's not going to buy you much in the Bay Area, but almost a quarter of home sales in the US in recent years could have been financed with a mortgage of $150,000 or less, mostly in depopulated areas. So areas that were previously industrial and have lost a lot of jobs, rural areas, but also cities that have lost a lot of population. And that is going to be a hard problem to solve, but the cost to originate a mortgage has almost tripled since 2009. Some of that is compliance costs, and we need to figure out a way to make small mortgages viable again. I think it is better to have banks offering more mortgages because of CRA, because they're subject to CRA. And we're seeing banks move in the wrong direction on mortgages, even as they're moving in the right direction on the other products we talked about today.
Great, thank you all. So we will open it up to audience questions now if folks have questions.
Hello, thank you all. This was awesome. My question, or I'll limit it to one, is for Jose. I was really intrigued by the sort of developing a formal product for the services or the transactions that people are doing in their community. And I wonder, is there any friction with mistrust or distrust for financial services and part of the informal services between community members, and I'm thinking of Susu's, is because they don't want to engage with the banks. And so was it difficult transitioning those communities to formalize their products? How did you guys go about it? And what are some lessons that you learned?
That's a great question. That's always the first question that's asked. So thank you for asking it, because I know the answer to it. After so many years of answering, the answer is no. It's not that people mistrust banks. And then the answer to that is not that, oh, you have to trust all banks. Because, the way we answer that is that, we should all have an ounce of mistrust for anybody who's handling your money. Okay? Even if it's your sibling, you have to, count the things, right? So mistrust is not the problem there. It was just that nobody was addressing their problems or their issues even in a cultural manner that they understood that, that relationship of a debt or savings or even the community building that was happening. Banks, they don't talk that language, right? So, for example, we require them to have a bank account. If they don't, we help them to actually get it because we manage all of the transactions through the ACH system. And then we as MAF, we're the ones that are servicing, and we're also guaranteeing those loans so that if somebody doesn't pay in, then we as an organization step in and make everybody whole. But our default rate is like 0.1%. So people always follow through with it. So, and I think you said this actually, where if you start with that premise of like, thinking that they're all prime, they all act like prime, so this is zero interest, zero fee loans, right? So we do that, right? And so I think it's not a question of trust and mistrust, but also we learned that they actually trust MAF. So there's a lot of individuals that are not coming in with their friends and buddies or relatives to join a lending circle. They actually don't know each other, because they're all immigrants from different countries, right? Or they come from a country, they come from different parts of that country. So they don't necessarily come in with that intimate relationship already, but because they come with a trusting, we build a trusting environment to build that community, they actually, respond in kind. And so there's, a lot of different ways to answer that, but But I think we kind of challenge the premise that, oh, it's because they don't like banks. We're actually good. Don't. I don't like, it's not the like or not like, it's we should all have an ounce of mistrust, which is a good thing, right? And so from that, we were able to sort of move beyond that to actually then build a product that they can actually truly engage in that was reflective of them. And that's what Responding Kind.
Yeah, great panel. I want to touch on measurement. I know you all had talked about it. Jose, you mentioned that financial inclusion is more than just an account. And I'm curious, we heard a little bit about this from the morning panel, but when you think about financial institutions and how they're measuring their client impacts with regards to financial inclusion, what's an example of where this is working? Like, who's doing this well, and what does that look like? And Janine, I'm kind of looking at you because you oversee this Association of Community Development Banks. Curious, like, if you have thoughts, but then really open it up to the panel. What does this look like? We hear about, okay, it's great to have the fees reduced. That's awesome. People are paying $5 billion less in overdraft fees. But when it comes to financial inclusion and thinking about more than an account, what does that impact look like? Who's doing this well?
Well, I guess what I'll say, from our experience, coming up with good measurements of impact that just don't, how many accounts got opened or how many loans got made and stuff like that, that is notoriously hard, those outputs. Those long-term outcomes, how did it make somebody's life better, those are much harder. And part of it, it's hard because it's expensive to do. There are, most of the CDFI banks, sort of have some form that they do. When it comes to things in the small dollar loan or the financial inclusion space, I've certainly seen a few products that some of the banks have had, and I'm thinking of specifically Bank Plus, which is a bank that's it's based in the Mid-South, and they've got a program, their Credit Plus program, where they start off with very small loans, $500 loans when somebody comes into their program. And, they pull a credit score, but they also require everybody to go through a financial literacy program. And they, first round of loans, if they pay them back, of course, that gets reported and, sort of with their credit score and stuff, but it enables them to then, access a larger amount of money, $1,000 the second round. But, what they have been able to see is those, well, they do have some losses and not everybody does pay back. They have actually said, the program has been pretty break even. I think they probably served more than 25,000 people at this point. But from those that make it, sort of to a second loan or to a third loan, they see increases in credit scores all the way. So that is a form, sort of an outcome measurement, improvements in their credit score. But I think the essential question you ask is, how do we know that, this activity is making a difference in people's lives? And we have a few ideas, but it is one of the hardest things to be able to actually measure.
Yeah, this is really one of FHN's sort of core part of our mission is to get folks measuring, to get financial institutions measuring the financial health of their customers, to get workplaces measuring the financial health of their workers. And we do see quite a number of financial institutions, banks, credit unions, CDFIs, either utilizing our 8-question survey-based measure of financial health or sort of using that as a basis and coming up with their own that's maybe most relevant to their the population that they're serving. We also see more and more increased attention on the utilization of alternative data, administrative type data. Often this is transaction level data or credit report data to measure the impact of a specific product or service, or just the financial health of sort of the customer base over time. Just to give one example, the OCC's recent Vital Signs program where they offer 3 sort of introductory ways to think about how to measure financial health for financial institutions, which I think is a great example of like, let's start measuring somewhere. And so we've been really thrilled and excited to see how many financial institutions are measuring in one way or another, and hope to see that just continue.
Thank you all. I just had a question that may be somewhat related, and to your point, Alex, about mortgages. And I was recently in a conference a few weeks ago in South Dakota, focused primarily on Native Americans homeownership. But what they mentioned was the amount of funding that's coming through from the National Clean Investment Fund and similar climate programs, like up to the $20 billion, let's say, which is between EPA and Treasury. And one thing that was interesting and caught my mind is that in order to unlock some of these funds, for every US dollar, federal dollar, they need $7 in private sector money. And it seems like it's an opportunity for, especially in Indian country with the lack of infrastructure, like there are opportunities to build more. But curious if this is another financial inclusion opportunity, you know, from an innovation side, but also if there's any research that you're looking at. Thanks.
Yeah, I mean, that does sound like an opportunity. Also, let's say in South Dakota, in states that are predominantly rural, there are a lot of obstacles to building, especially on site, but I've seen there is real investment in off-site production, and so in manufactured housing. And we've seen a couple of steps this year from FHA, from Ginnie Mae, to make it easier to finance manufactured housing. But boy, there's just been very little activity from banks and credit unions, for the most part, in financing manufactured housing. And I've realized that you know, they're citing compliance concerns and limits with profitability. And so we're overwhelmingly seeing manufactured housing financing coming from a relatively small number of non-bank lenders. And there's one credit union that's doing some volume in the space. But I think it's absolutely a real opportunity, could be a good opportunity for CDFIs, but to unlock, yeah, exactly, to unlock that. And especially if there's federal money available, it's a good opportunity because this is a specialty area. I think there's some stigma attached, but for home building, especially in rural areas, I mean, I think manufactured housing and factory production is just such a big piece of the puzzle that has been underutilized. And even though modular construction has never really beat site built on cost, traditional manufactured housing from, you know, the big companies that do it under the HUD code is absolutely much, much less expensive than site built housing. Single section home, good quality, HUD standards, net zero ready, can still be had for under $75,000 from a manufactured home company. And the real problem has been on the financing. So getting that financing in order and getting affordable loans in place could absolutely unlock home ownership in low-cost areas, in marginalized communities, and in rural places where home building is tough, especially with the decline in electricians, welders, plumbers, and other on-site skilled trades.
You talked about some of the advantages that technology can provide in terms of cost and how it can be implemented to increase inclusion. I was wondering if you could talk a little bit about examples where technology cannot replace humans in this space. Like where are the critical places where you need people now and potentially need actually more people focused in person or on the phone? Like where is the personal touch really important for financial inclusion?
Sometimes we talk about low tech, high tech, and you know, I like to talk about it as more like smart tech, right? Which is definitely, you know, we have for different programs, we have our personnel, our staff, they're the people that sort of walk people through a process. So, so they need that technology to help them. So in a sense, we built the technology to help our staff do better, right? But yeah, there are instances where, some of our staff, they spend like, good chunk of time, like an hour at a time, just helping somebody fill out an application online. But we sort of expect that because we know that most people are going to be able to sort of fill out that application online. But some people are just going to need that extra help. And so we rather do it like that, just focus on some rather than all, right? And so in that way, we don't necessarily force everybody to go online to fill it out because we know that some segment of folks are not going to be able to do that. So that's an element of us trying to be, cognizant of the different barriers that people have, but also at the same time, not building the system based on those barriers alone. So it's that we don't require everybody to talk to to our staff, because then we won't have enough staff to ever do that, right? So it's kind of being, agile in that sense. But I think that comes from knowing your market, knowing your clients, knowing what the barriers are that you foresee, and try to adapt accordingly. So not coming out with a one solution for all, but it's more like how do you build something so that you can accommodate as the barriers come more clear. I hope that answers.
I was going to say, the answer I would say is anybody who doesn't fit the box. And I think that speaks, sort of to response that you provided. There are some people that filling out the online application is going to work just perfectly fine, and they don't want the fuss, and they just want to get it done. But I think, to be serving underserved niches, you've always got to know that, sort of it's always about crafting the product to the need of the customer, which in many cases means you've got to do something unique. So,
yeah, I mentioned financial information or financial advice, and I think that while there is a huge emerging sort of market for providing financial information or advice via AI technology, I also think that that we have a ways to go for a number of reasons. The other thing I sort of wanted to mention is that while technology does a great job of unlocking some doors and providing access, I'm not convinced that we are equipping consumers to sort of walk through those doors in a meaningful way. One example is investing, right? So you can invest with $5 in 5 minutes now with some of the online brokerages. And part of my work is looking at whether we're adequately preparing consumers, potential investors, to make decisions in their best interest when we're using jargon-laden financial education that's not culturally appropriate. And so I think along with this technology, we also have to really think about, are we arming people? Are we preparing people in adequate ways to utilize the technology to their best interest?
I think we have time for one more question, if there's one out there.
Hey, my name's Drew. I'm from the Cleveland Fed, from the Pittsburgh branch, and I really appreciate you guys talking about barriers. And one of the things we've been working really hard on Pittsburgh is understanding people's multiple intersections and barriers that they're facing. So again, you might have multiple identities, and you solve one problem over here, you're not really solving the whole problem. And I think that goes back to the personal touch, where we're like, it is neighborhood by neighborhood, person by person, individual by individual. And also, we found in the immigrant community, a lot of people don't want to say, like, I'm an immigrant, I'm disabled, and to put both those things on the application for a business application. So just talking a little bit more about that personal need and intersection boundaries, to really get at financial inclusion, because I think that's maybe a lot of what we've been missing is we're solving for one thing, but we're not really working with somebody to solve their everything, which you got to be more holistic when you're talking about people and their lives.
Well, thank you for bringing that up, and I think this kind of goes back to the notion that, like, if we just have this imaginary consumer that is like in the median of everything, and then we want to build products and services to this imaginary entity, what'd you call them in the box?
Yeah,
the client in a box.
the cardboard, the meeple of a consumer, exactly.
Yeah, I mean, if we do that, then we won't be serving, the clients that you're just mentioning. But it does take a little bit of savviness. And how do you start those conversations? Do you just show up, and talk to them as if you were talking to this other client? I think there will be a disconnect if that's the case. But I think if you do, build a product or even a rhetoric or narrative that is pertinent to that particular community, I think you'll see a much more alignment between you and what you have to offer and what the needs are. Because sometimes a disconnect, we may think that is that they just don't trust us. But I think it's just a disconnect in the terms, in the language, in the way we approach those issues. So I think there has to be, again, the savviness of how to partner and have multiple code switching, if you will. Like the ability to have one conversation, but in multiple ways with different communities. And I think that's what technology can allow us to do that, but we have to be mindful of how to will that idea, right? So, my challenge to you is to kind of embrace that complexity, because through that embracing of that complexity, you'll find the elegant solutions through that. Because it's not going to be just taking what you talk to this, this type of client and then translate it into Spanish, because then you still have the same problem, but it's about embracing that complexity so that you can kind of see, the potentials, and realities there.
I think offering products that people want and need also builds a lot of trust and a lot of goodwill, and making them available. I'd been talking with folks years ago about this, and had heard, payday loan borrowers don't want to go to a bank. They don't trust the bank. Do you offer a small loan? Well, we've got a $5,000 minimum loan size, and we turn around an application in 10 business days. Okay, I hear that, but then we surveyed 22 focus groups with payday, auto title, and subprime installment loan borrowers. And absolutely, they already had a checking account. They just knew they couldn't go borrow $300 from their bank. 4 of the 6 large banks have a maximum loan size of $500 a year for this instant small loan. We surveyed payday loan borrowers. 80% said they'd rather borrow from their bank. We knew there was appetite there, but there was a perception that there wasn't. But the real problem was the products they needed weren't being offered. And good products and accessibility, I think, solve a lot of problems that may seem like they're about culture, about trust, or about preference, but are really about utility.
The other, know your customer. Please join me in thanking our panel. And Eric Belsky, DCCA's Division Director, will wrap us up here. I'm sure he'll do the requisite thank yous, but for this panel, I would definitely like to thank Kirsten Noland and Jennifer Fernandez for all their work in putting this together. Thank you, everyone.
Thanks, everybody. I'm going to just make some relatively brief closing remarks, and I'll start by thanking everyone for coming and joining us here today. Very full day, very rich in information and insights on a very wide range of subjects. So thank you for coming. I especially, of course, want to thank all the people who participated in panels, the moderators and the presenters. So a round of applause again for that great group of people. I think today we heard facts and figures that drive home the importance of financial inclusion, but we heard a lot about the challenges of actually creating financial inclusion. And I would say probably most importantly, doing that in a way that we feel we're setting as many people up for success when they engage in the financial system as possible. And that can be challenging in this space. I'll talk a little bit about why I think that is the case. But this is essential work. It's the work that people in the room have devoted their careers to. It's work that we see banks doing, CDFIs doing, community-based organizations doing, really trying to expand access to credit, to bank accounts that can be such an important entry into so many parts of the financial system. So many Americans live with no slack, and I use that term, no slack, because that is the title of the book that the Vice Chair for Supervision that you heard from first thing in the morning titled his book. And imagine what it's like to really essentially live with no slack. Now, certainly lots of people who could be included in better and more meaningful ways in the financial system have some slack. But that's a very important challenge when you're in a situation like that and you need to get someone to extend you credit and they're looking at, you know, your financial circumstances. It turns out it very much is possible, but it certainly can be challenging. The Fed's survey for household economic decision-making demonstrates how many people are living really close to paycheck, and lots of independent surveys confirm and quantify this. This means that people are very vulnerable to income and expense shocks, and that can leave them, you know, more or less desperate to borrow, even at high costs, in the hope of managing through those shocks. And the same holds true for small businesses, for whom an interruption in activity can really be very difficult for them to manage. But it's also the case for people who are looking to get longer-term credit to be able to invest in themselves, in building wealth and homes, things like that. So for consumers, many of whom are not doing so great financially, liquidity challenges can be especially difficult. So we heard a lot about those small dollar loans, small mortgage lending, things like that over the course of the day. We know, though, that tens of millions of people, and that was the first paper, have no credit score, and tens of millions more have thin credit files, which means it hasn't been used recently or it's not sufficient to really form a credit score. And then we have lots and lots of people, of course, who have credit scores, but those credit scores will either not allow them to qualify for loans or will cause them to qualify for loans at higher prices, certainly, than prime borrowers pay. But we also know, and researchers and industry are finding that by turning to other data, so there's optimism around this use of other data, that there are ways to identify creditworthy borrowers among those with no credit scores or thin files. And we know the same holds true for so-called, as they were called this morning, invisible prime borrowers. Industry's finding that information on inflows and outflows, and you heard this from Governor Bowman and others, from customers' deposit accounts, when permission can result in lenders expanding access at lower cost than might otherwise have been possible. And we heard about that just on this last panel, that it's maybe for want of those products, but we're starting to see those products now be offered by some very large banks at scale. And we're finding that behind their ability to do that is their ability to use this cash flow information from their customers' own accounts. And this is particularly important because we also know that the rate of ownership of bank accounts is dramatically higher than the share of households who have someone in them who has a credit score that would even allow them in the traditional sense to receive credit or to receive credit that isn't at very high price. So this potential for the very vast majority of Americans who own bank accounts to be served by their own banks through the use of this information seems to be significant. And we heard today that thoughtful, intentional, and responsive financial products, and I use all those words intentionally, thoughtful, intentional, and responsive financial products and services. Jose talked a lot about, how responsive these are, and often the level of tailoring that has to go into them, because not everybody experiences the economy or financial markets in the same way, nor would you expect them to. That it's really important for those thoughtful, intentional, and responsive financial products to be offered on solid terms and using practices that are fair and that are clear to customers, whether that's for helping, as I said, to cover costs of unexpected and unmanageable expenses, or saving to avoid the often high fees and interest rate charges associated with short-term borrowing outside the banking sector, or whether that's for expanding access to or reducing the cost of longer-term credit to buy homes, start businesses, or further an individual's education. So while we heard about ways in which innovative financial tools can build resilience for consumers and households, we also heard that meeting small dollar needs in particular carry heightened risks, including the risks of customers falling into a cycle of debt and repeat fees. We also heard that while the use of alternative data presents opportunities like cash flow data, it also carries risks that must be well managed, in particular when you're using data that may not have as obvious a logical connection to credit risk as something like cash flows in and out of someone's account. And we heard about some of those this morning, which when people heard them, they laughed, but their potential for use is real. Their potential to actually result in a less discriminatory alternative to a more traditional model is real, but so are the risks associated with those data. So we heard that while they present opportunities, they carry risk that must be well managed. Alternative data that have not been used over large populations and tested over sufficient periods of time, which is to say a lot of that data, may not be reported reliably, and their performance under future conditions isn't as certain as it might be for data that's been used a lot. So in addition to all of that, many are correlated with race, and therefore they raise fair lending risks. These are all things, obviously, that people who are working in this space need to be cognizant of, and they need to manage those risks. That is what the business of financial services companies are, basically. They're in the business of managing risk and pricing that risk. And so certainly they're well-schooled in doing that. Governor Bowman talked about in the banking sector, the close regulation and supervision. There's over 30 consumer laws in the United States to protect consumers in financial markets. Those are all very meaningful, and banks are accustomed to understanding the importance of doing those things. We heard that the cost and convenience are key to the use of payment products that would improve inclusion. We heard the importance of tailoring products, as I said, to individual circumstances. All of this is to say that while there's a lot of promise here, there's a lot more we can and need to learn. And as a researcher, I'm not doing this just as a plug for research. I do think, we're in a deeper and deeper conversation using new data, new tools that really present opportunities, but we really have to wrap our minds around them, and people who would like to use them and see the potential, and I think we do, that they do so in a way that's responsible, in a way that manages the risks, both for compliance with laws and regulations, but also just doing right by customers. So let me talk about some of the things I think we need to learn, and I'll close with these. First, we still have more to learn about specific financial products and services to judge whether they help build financial resiliency or ultimately they undermine it for a large enough proportion of their users to be worried about. And they can do that in a number of ways, but one of them on the short-term product side that we've seen is people ending up in repeat cycles of getting charged high fees and interest rates that reduce what they can otherwise hold on to from their earnings. Second, we have to learn about the reliability, quality, robustness, and fair lending risks of alternative data fields, work that is very much underway now. Third, we have to learn more about the use of novel modeling techniques like neural network models. If you've ever gone online to figure out what the output looks like, or even what's going on inside the box, it's a bunch of binary code. So it's really hard to kind of figure out exactly what's going on. After the fact, you could look at what it does, but it's not in the conventional sense that you would look and go, oh, I see, it's these 4 variables, and they interact in this way and that, or 6 variables, and that's what produces the output. So I do think we have more to learn, and we're intent on learning it. So let me close by thanking you all once again, and by reminding you that the Federal Reserve take these issues very seriously. We will continue to explore how we can make a positive difference through our research, which is a large part of what the Federal Reserve does, both here in Washington and at the 12 Federal Reserve boards. We're in many meaningful ways a research institution. Convenings like these, where we bring people together to share information, talk, think about what more we can do. And again, we're very active in doing that. Then there's also the work of our Federal Reserve banks, which we didn't talk so much about, but all our reserve banks are out there trying to encourage and inform local multi-stakeholder initiatives to form and to support them. As you may know, the Community Reinvestment Act basically says banks have an affirmative obligation to meet the credit needs of low and moderate income communities, and that the roles of the agencies that write the rules around it and supervise for it is very much to encourage that to happen. One of the ways you encourage that is just creating a good set of conditions for stakeholders to get together and realize, hey, there really are opportunities here, and support them through things like our ability to research things and provide information that's grounded in facts. So we'll continue to do that. We'll continue to work through our Partnership for Progress, which focuses on MDIs, but also women-owned depository institutions. You heard our very significant focus on community development financial institutions. Didn't get into all the ways that we did it, but we also made a very strong effort successfully during the COVID crisis to build them into our emergency programs as best that we could, or create channels for them to be able to tap into those. So we've done a lot in these areas. And we also, as Governor Bowman mentioned, have a really strong interest in what's going on in native land areas. And we have a center in Minneapolis, the Center for Indian Country Development, that works on this. But every reserve bank pretty much is doing their work in this area, and we're working on it internationally through this network that Governor Bowman spoke about. I want to make sure I don't leave an audience like this without saying we're always open to ideas for what we can do to help. And how can we help, given what we have as pretty broad statutory mandates for monetary policy, payment systems, consumer protection, the Community Reinvestment Act, safety and soundness, and the formidable research capacity that we have. We view all of these things as, the things that shape what our role is in the world, in this space, and in others. So we all, I think, regulators, banks, nonprofit, community-based organizations, consumer advocates, researchers, we can really all help to create a more inclusive economy by working together, by seeking out opportunities from our respective positions and from our respective responsibilities. So that's what I wanted to say in sending us off to a reception. The last thing I'll say is I hope you manage to move quickly through what is the thick and hot air in Washington, D.C. today to wherever your cooled and air-conditioned space is, and be thankful for electricity and air conditioners that work. Thank you.